Sure. All right, cool.
Hey,
So
can I say
you
something?
should be able to. Yeah, go ahead, buddy.
What I've been doing the past 2 nights, I'll like kind of time step it myself. So if you guys say something, what I'll do is I'll look at the time when you guys said something, and like the time now when you start into the time you guys say something, should track the time. So if we're like halfway into the video, because you guys say it's a lot of good stuff. That's the best way I timestamp. I look at the time when I hear something I like, and then I'll subtract the time. So for anybody who wants to, try to play it like that, that's probably the best way.
No, it's a great
right on,
point,
man.
dude. Yeah, I'm taking
Right
notes
on.
too.
Can you guys see
Yeah.
my screen?
Yeah, there we go. You're good to go
All
now.
right, so this is Y charts. Okay, it's an expensive toy for me that's wasted completely. It's not that expensive. It's $400 a month, but it's a waste. I don't use it as much. But one feature they do have that's really nice is their screener. So just for example, what I'm screening here, can you guys see, or do you want me to increase the size?
Increase it a little bit. Yeah.
Yeah,
'Cause
just
it's
a little
only
bit.
there. You go. No,
Okay.
yeah, that's good. Yeah, you
All
just
right,
may have to
so-
scroll
so-
down, but
So they have a very programmable screener. So what I'm screening right now is just for the heck of it. Okay, this is a saved screen I have. I call it beat and raise screen. So basically, I'm filtering the technology sector. I'm clearing out all the OTCs and Toronto Exchange stocks. So we want to see only NASDAQ and NYSE. Okay. So then I'm going into the metrics and filtering out only companies that beat on revenue, beat on EPS last quarter, and their estimates for this quarter are higher than last quarter. Okay.
yep, makes sense.
So it just dumps instantly. There's 52 companies. Okay. Now, whether or not this is the right scan is a different story. Just for simplicity, right? This is just as an example what I do, right? I go into this and say, you know what? I don't want anything to do with UiPath. They've messed up. I don't know what Kumu is. I'm not going to touch it, right? So okay, go down the list. Zoom Info looks interesting, right? It's a company that's here in the valley. I know Confluent looks interesting to me. Desktop Metal is a 3D printing company that I know. So I just go through Splunk. I have an investment in it, so I'm interested. Cirrus Logic, yeah, I know that one. MongoDB, I like them. Nutanix, I have friends that work there. So okay, I know some companies here that I want to see, right? So then I can either go in here and take a look at the company, or actually let me do something. Let me go back and modify what I'm sharing so I can share this whole monitor. Where am I? Here. All right, wait, let me stop sharing and share the whole screen one. Okay. All right, now you can see my screen. So what I'll do is I will bring another one. Let's see, what do we want to show? Okay. So let's say okay, where are this? Okay, so let's take a company that we know there. Let's take MongoDB, right? This is OptionStrat, by the way. So to increase this. Okay, can you guys see this?
Yeah, that's perfect.
Okay, so the way OptionStrat works, right? So if I want to do just a swing trade and I'm not really looking to go deep into financials and stuff, I can do all that here in Y charts. But if I just want to do a swing, I want to see what option idea will work, right? So basically, the way OptionStrat is set up is it gives you groupings of potential trades based on how you feel about the market, right? How you feel about the stock. And typically it lands you. So let's just actually, it lands you in, in bullish, if the stock is bullish. Okay. But you can change its mind. You can say, I'm very bullish, right? But let's just take, we are bullish because they beat last quarter and they're likely to beat this quarter. Okay. So if I want to, let's say, look at a call spread, right? It brings up a configurator. Okay. So the expirations at the top, I can pick whatever expiration I want, however long I want to play the trade. Okay. I can move. So it will give you what it sees as the best option right up front. Okay. So so it's, this one is saying I think it was November 4th. I think this was the default, right? So, okay. So this one is saying, your best chance of money in this one is a 200, 230 call spread for November 4th. That's going to cost you $1,000, and you can make a profit of $2,000 at a 40% probability. That's, very quickly, and you can see this graphically too. You guys know how to read this, so I won't, go into that. What I do is, I'm not satisfied with what they gave me, right? I want to adjust that, or I want to complicate this further because this cost is too much for me. I don't want to pay $1,000 for a contract, right? If I want to do 10 contracts, that's $10,000. I'm not going to do $10,000 and wait, a month for a payoff, right? So what I'm going to do is I'm going to get a bigger payoff that I won't have to wait. So I'll say, I want to go out to January. I want to buy myself time, right? So a 200, 230, the probability has increased, the profit has decreased because the cost has decreased, right? Right now it's $199. I'm not going to, try and get a $200 contract now because you pay a lot for this near, call, right? So I'm going to move it out. So let's say I want to do a 220, 270 call spread. That's a, that's a 50-point call spread, right? Now the cost has increased. Obviously, it's 1,350. So what I do is I typically come here and add another position here to pay for it. Let's say I don't think it's going to go below 170, and we'll get to that in a second, right? Now by selling a 160 put, I get, instead of paying $1,300, I get a credit of $95. Okay, so I get paid to do this trade. The probability has increased dramatically to 71%. My profit has gone up threefold, from 1,000 or 2.5 fold. It's $5,100 now. Now, what is this loss, right? This looks like a bad, risk return. But what is this loss? What does this mean? This means that the cost of this trade could be that I end up having to buy this stock at $160 minus the $95 credit I made. Does that make sense?
Yeah, I mean, it does to me for sure. And that's the
Yeah, it makes
reason for
sense.
that
Yeah, I
is,
got it. Yeah.
yeah, because when you sell a put, you're
Correct.
you're basically saying you want to buy it.
I mean, this is when we need Brendan here, right? Now I don't not randomly pick these numbers, right? I go to a chart and find where these levels are, right?
Yeah.
160 has to be somewhere below a gap down, below a gap up somewhere long ago, right? So the likelihood of that 160 being breached should be very low, right? It should never hit that 160. It's 199 today. That's 30% down from here, right? $30 is 15% below. Maybe I don't want that, right? Maybe I want to go to 150 and I will bring this down, right? A little bit, right? 260, right? Now it's a $10 credit. So this works better. I brought the, so I have two shorts and one long here, right? I have a long call, I have a short call, and I have a short put. Now you have to manage the call spread together, and you have to manage the put separately. The put is what is going to bite you. So what you want to do is, if the if the price starts going this way, meaning from 190 it goes to 180, you will be at a loss on this put spread. You probably either want to roll it to a lower strike, or you want to take that loss and take that off for now and just let this, go, or close everything, right? So there are multiple options there. Typically, you want to have this at a point where it doesn't really hurt you, even if it goes down day by day into, quite a bit, right? So this is $50. That's a 25% drawdown from here. Now, I don't want to pick a stock that has a 25% drawdown chance. Now, market might get screwed and it might happen. That's a different story. But what I typically do is, if this starts going against me, I will roll this or I will close this part first if I still think that this will come back, right? So you can do one of two things. You can close this and you can close this, just leave the call open. You'll probably get a decent credit, because as the stock price goes down, your premium becomes fully yours, right? Because this is a short call, remember? So whatever premium you got collected for this is going to become zero. So you keep all the premium you collected here and you lose it here. So you have to constantly keep adjusting those two. But the reason why I do this is, now let's say it goes your way. Let's say so your break even is, you get a $10 credit. The cost of the strike of the put is 150. So the put strike minus $10 is your break even, right? That's where this 149.90 comes from. Make sense?
Yeah.
Okay.
100%. Yeah.
So
basically your put is the important
risk.
part here.
The entire
real
risk is the put. Yeah.
Okay.
Yeah. So now, why do I want to do, let's say I know the stock is going to go up to 220. Why do I want to do this instead of just buying a call? First of all, if you look at the call, right, the call price is $24. Let's just say split the difference, right? 23.70. Okay. So I'm going to have to, for every call, I have to make 2,000, I have to pay $2,700, $370. It's not worth it, right? It's 200 today, 220, that $23 call might go to 27 if it goes to, or 28 or 29 if it goes to $210. But if it goes to 210, I'll probably get $100 credit from here. I'll probably lose a little bit here, but I'll probably make another 150, $200 here. I can close it. If from my $10 credit, I can take another $300, $400, $500 in a couple of weeks and get out, right? I've not lost anything. I've closed my what do you call, margin from here, and I'm out with no money that I put out except locking my margin. I've made $600. If it really moves, let's say we picked a company that is likely to do well and it really moves up, right? Let's say it moves to 250. Now your 220 call is in the money. Your option premium for the sold put is worthless. I mean, meaning all the option premium is gone. Whatever you sold it for, you keep it. This is the only thing at a loss. So you'll make even more money. So as it starts going between the 220 and 260, you make money on two legs, you lose money on one leg. So the probability of making money on a swing trade is much higher in a this is called a financed vertical. So in a financed vertical, the probabilities are always much higher. Look at this, right? The probability of profit on this is 76%.
Yeah. Yeah.
Right?
And so the only thing that's required is the cash to cover the cash covered put, correct? For the margin.
So yeah, it won't be $15,000. It will be like, $2,000, $3,000 to start with, and it will keep increasing as the stock moves down. Right. It will keep decreasing as the stock moves up, which is why you have to manage this carefully. The sold put is everything. That has to be managed carefully.
Monetive, doesn't it mention to you right on there if you need margin required to make the trade?
It'll tell you,
Um,
it'll tell you exactly how much margin is required, or your cash is locked, right? So if
Yeah,
it's a
right, but
cash
some,
account,
like some trades, like obviously like a short call naked, you would need margin no matter what. You can't have it cash geared, right? So like
Correct.
it's just always nice to know whether or not margin is needed for the trade. Is usually a less level of risk associated with the trade that would not need margin posted.
That's right. Anyway, as soon as you load up, your broker will tell you 99% of them, all the ones that I use tell me exactly how much margin is going to be required for this. And for me, it's not much, right? But what I typically do is stocks like First Solar or Enphase, you know, I look at the charts, find the levels that make sense for the, you know, for the, you know, near strike, the long call and the short put. I mean the out call and the short put. I find the levels that, to the best of my knowledge, actually you guys can do a better job at that. So I do that. Once I find those levels, I calculate, you know, nearest to that where I can get a credit without breaking those levels, or at least keep it flat. And what I do is I'll buy one contract and then I'll put a few more contracts at greater credit, assuming the price goes down a little bit. If it doesn't, then, you know, I'll find a new contract to get a credit, right? Because the price moves up, this credit will disappear. You have to adjust it more, right?
Have you looked at it with, have you used the chart view, the graph view
Yeah.
to show like the yeah, as well? Okay, great.
Yeah, I'm more, you know, data than visual. So I just like the table. It's just simpler. It speaks to me. But 90% of the traders, option traders, use the chart view. Right? This is your, you know, I mean, it basically, this is no different from for any option, right? Because it has 3 legs, it looks a little bit different.
Right,
So
and now
anyway, I
the
think this side of it you can explain better. I was just going through process
No,
wise
it's
what I do.
it's perfect. I was gonna say if you go back to the table
Yeah.
real quick, and then you just like slide one of the strikes, right? You'll see the payoff when you do the table view change so dramatically, and it's
Yeah.
sometimes
Yeah.
like it's
And
eye glaring to see.
yeah, and that's what you were doing when he was showing the put, I believe.
Yeah, I
We were
mean, look,
looking at the max loss.
$10 makes it a debit instead of a credit, and now your probability has gone to 40%.
Right.
Yeah.
That's
So
exactly what I would say.
this is why this
When I-
$40 a month is worth it to me.
This is why I
Yeah.
always say sell expensive IV, right? The difference in those $10 in strikes, one of them is just so much more expensive, right? That by selling that strike, you're actually changing the likely outcome of your trade by a significant percentage.
Yeah, by almost half, you know, or double, I mean, but yeah, that's no, and this is great. And that's the thing too with this, for anybody that's not familiar at all with spreads, you know, that's where this visual, at least for someone like me, is I mean, I understand what you're talking about, you know, as far as the setup, but still being able to see this change. I mean, that's just, unless you do it every day, you're not gonna, you know, the visual is huge. Like you're not gonna be able to just call this up without.
I do it every day, and I still use OptionStrat all day.
Yeah, right.
Yeah,
Good
I mean,
point.
look,
Yeah.
Brandon can probably calculate close enough to their algorithm what is an ideal trade, right? My friend Archana or Nargis, these are all people that live and die by this every day, so they can do that, right? Also, remember, this is not the only trade, right? Like it tells you what are different options available, right? You could do a put spread, you could do a broken wing butterfly, you know. So
before we go any further, my question is,
Yeah.
so I'm used to playing, you know, like ETFs or big name stocks. Do these work on stocks that we're familiar with, or are we playing small cap stocks?
No.
What stocks can we do this with?
Let's take the biggest one, right?
Like
It works on
Apple.
every single
Right.
pair with options.
Let's just go to
Works
Apple,
on
right?
anything that has options.
So-
Yeah.
No, I
yeah,
understand it works, but does it work as efficiently?
Of course.
with the bigger stocks.
Usually, usually more efficiently because the
They're
more
more
liquid
liquid.
the options contracts.
Yeah, it's more liquid, right? You have a chance of hitting it better, right? So okay, let's say Apple is $145, right? We don't even need to go this far out with Apple, right? So let's say Apple's earnings is somewhere in the third week, okay? So I don't want to. So you have two choices, right? You can either do it pre-earnings, right? Okay, let's just say you want to do it next week just for the heck of it, okay? You want to buy it's not going to go to 170, so you want to buy a 145, let's say 146, right? 146, 150, call CDS, right? Call debit spread, right? It's going to cost you $165. I don't want to pay, so I go and I sell a put. Let's say I don't think it's going to go to 130. Where can I get a profit? Okay, come on.
So my second
Not
question
even worth it.
is the time. So you picked the date of October 14th. On the last stock that you showed, you picked January of 23.
Okay, so there was a good reason for that, because we were trying to do something else, but you wanted an example, so let me answer that question. It's an excellent question. So this was going to be about swing trades, right? Giving yourself time to let the trade play out for a larger profit. Yeah. So I did a scan of companies that beat on revenue and EPS last quarter, and their estimates for the current quarter is higher than their numbers for the last quarter. I just ran a scan on my, on Y charts, right? I use Y charts. So it gave me a list of companies. These are companies. Okay, what does that mean? Basically, these are companies that are likely to beat again, right? There's a probability. Whether that happens or not is a different story. But for simplicity's sake, let's assume that companies in this list have a better chance of beating earnings this time, right? So we are through this earnings. I don't want to go beyond next earnings. That's why I picked, December or January, whatever, right? They are going to report in February. We can see that example. MongoDB next earnings date is when? Next earnings release is December 6th. So we might, so they reported only in August, so they're releasing in December. So if I saw that example, I should have really gone December 16th to play it safe. That is still 2.5 months for the trade to work. So I was just giving an example, but that's the level of rigor you have to go through, right? You have to make sure, because options get burnt by earning moves, which are violent.
You should know the earnings of any stock that you're trading, even if it's, I mean, granted, if you're trading intraday, maybe you'd hear about it, but you should have an idea about it. And if you're trading on TradingView, just zoom out to the daily on your chart each day, and eventually you'll see it pop up. So
yeah.
As you approach earnings, you'll see premiums will begin to get more and more expensive, right? So like you always want to know when earnings are around. A, for the the surprise, but B, because it'll explain why option premiums can be jacked up.
And the whole thing with IV, you definitely want to know when they are, and it gives you an opportunity to start learning about the inner workings of contracts for sure.
Yeah, I was gonna say, Brandon, do you ever trade IVs? You ever do the options for IVs?
I pretty much strictly trade IV. Like that's exactly it. Like if you get advanced in options, the goal is to be selling expensive IV and buying it back cheap.
Yep.
Right. And the goal,
Yep. No, I was just gonna say that's what that I know, Mills, you weren't in here, but we're gonna do that class this Saturday, I think, right? We should lock in the time here, not to take up too much time with us right now, but later, right? We can chat about it in the chat, but that's what we'll get that done, and everybody should definitely come to that, because I think and we'll have it recorded, so that's going to be key. So
so anyway, that procedurally that's it, right? There's no magic to how I pick swing trades. it's basically starting from fundamentals, right? For me, it's always, buy a stock that has a chance to go up because it does well financially. That's my first step. Second is, are they going to do good this quarter? There might be great stocks that have already said they're going to do bad. I don't want to touch them, right? So which is why I do specific scans to bring a list of stocks that make sense. Then the third thing is, I want to, pull up, let's say, where is this? Right, I can do it here. It's just easier for me. That's all. I don't have to do it here. So I can look at pretty much any information at a level of detail more than, most, other than Bloomberg, this gives me the most information of any company at any level of detail.
What's the website? Because we can't see the actual website. I know it's
This
charts.
is called
but-
Y charts. It's not worth it.
Charts.
I mean, it's
Okay.
really not worth
It's
it. It's
quite
$400
expensive,
a
yeah.
month,
How much is it?
400 a month.
Oh, okay.
Looking for
So-
like option screeners though, bar charts, option
Yeah.
screeners, like
Yeah.
it has improved by like, for a cheap version, like, or
And
or free,
FinViz, I
but-
know, isn't FinViz good too?
Yeah,
Oh.
I'm just saying like for bar chart, like it'll have like options. It'll have like covered calls, naked puts, credit debt spreads, straddles and strangles, butterflies, and iron condors with a screener that allows you to rank each column, like profit, but like likelihood,
Yeah.
you know what I mean? IV increase, etc.
Yeah, I can show bar
How much
chart.
is
I
that
have
one a
it.
month? Do you know?
Bar
For
chart
like
is
25 screens,
bar chart
and
is
then it's up to
29
like
bucks a month or something. It's cheap.
29, yeah.
Okay.
I'll show you bar chart in a second, but basically the reason, Brandon, the reason why I like this is, when I was doing this, we were, we were discussing raising a fund with my partners. This lets me build reports, right? I can go, generate a one-page report.
You
of
don't have to
stuff.
justify it to me. I have a Capital IQ account. You don't have to justify it to me.
Same difference, right? So for sending reports and stuff to clients, this would have been good, but
Absolutely.
I don't use it for the intended purpose. The only thing I use heavily in this is my screeners. The screener here is really better than almost anything I've seen. But anyway, I can go compare, right? I can see, what is the return with companies that they have comparisons for, or I can change these companies to what I know is the right one. So it's very easy to go change, what companies I want to compare it to, but it gives me an instant, dump of the, financials. So the stuff that I do, these things are very valuable. But anyway, it does have technical charts. So we'll just, for simplicity, use it here, right? Okay. So this is your MongoDB daily. It is daily, right? Yeah. So there is where is this? Okay, let's make this a little bit bigger. So it is, I need to probably see it over a longer period first. Let me go out.
If you're on the Apple options and MongoDB screener, just
No,
remind
they're
you.
not. Yeah. I know. Okay. So maybe I can go back here. This is not visible. This is not a great chart tool. So just for the heck of it, right? Bear with me here. We'll go back all the way. So we are at whatever, $200, right? So where is my pointer? What's that? I don't use this at all, so I'm struggling. Anyway, so we'll just wing it, right? We're at 200 here. The next support level is probably somewhere in this range. Nothing here. We have to find if there's a gap somewhere that can provide some support. I don't see anything off
You
the
probably
top.
got one at 150 right there. So in between your 125 and 175.
This one here.
Yeah, if you go to the left, see where we popped up, where we first land to the left over there. What is that?
Yes.
April 2019. Yeah, somewhere in there, right? If you draw a straight line across, you'll
Yeah,
Yeah,
so
from like April
probably
19.
let's assume the support is here, right? So you want your put somewhere below that support. So the likelihood that that support will hold and your put will not be enforced, right? You don't want to buy that stock necessarily. So that is that cost, right? Where is it? If we go back to MDB.
Now, do you also look at the options chain and see like what is liquid and what isn't, as far as
It brings it up, right? It see, for example, right? It shows their low
So
open
the
interest.
bars, those
Okay.
bars, how long the red bar and green bar are the volumes on each strike. But that's
Okay.
not necessarily liquidity at it, right?
Right.
It is volume.
right?
I would make sure you just view the bid ask on the option, right?
Right.
When before
Yeah.
you execute it. And rule of thumb, right? Take the bid minus the ask divided by the bid. And that's going to be your percentage that you're basically paying as the spread, right? Whatever
right.
the difference is, right, over the original, right? So like basically my rule of thumb personally is I'm not willing to pay more than 10 to 12% ever to a market maker,
Yeah.
right? Strictly for executing the trade. So
Yeah.
I usually like to look at the bid ask spread percentage to make sure that there's, you know what I mean, it's liquid. If it's a wide spread, it's illiquid.
Brandon, did you say bid minus ask divided by bid?
That's right.
Thank
Yes.
you.
So anyway, this gives you a visual, right? Just for quickly moving things around, it tells you, okay, this MDB was not the best example, but I just threw it out there just as a starting point, right? So it tells you there's very low open interest in this. So this as a starting point for the option might not be the best idea, right? It looks like this is not a heavily option stock. It just looks like, you know, the call side there's not much here, which would not be a problem for your Apple or your Tesla options. But anyway, so the point is you come here to the technicals, find your levels, right? Okay, so there's support at, let's assume that trader was right, there's support at 135 just for the heck of it, right? So you want your put somewhere at or below that 135. And then you go up and say, you know what, where is the first resistance here, right? For the call side. There's two parts, right? One, the closer you are to 200, the cost of your whole option is going to be determined by this long call, the first call you buy, right? Because that's going to be the most expensive part of the option. So you don't want to be at the money here. You want to be not too far from the money, but you want to be near enough the money. So maybe like a 210, 215 or so. This stock does move a lot. So
Monetive, do you judge how wide of a spread you use by the delta between the spreads or no?
I am not so. I'll be honest, Brennan. So what I do is you know, I'm not that sophisticated. I brute force it and then I send it to Archana. She helps me.
Yeah, no, I'm just saying I would bet you that the price levels that you end up choosing, right? If you just look at the delta 50, it's always going to be like in the money, right?
Yeah.
A delta, like a 20 wide delta spread is usually ideal for like in terms of like the range of the price of them that the stock can move within that time period, right? And
Yeah.
that's going to be like selling the delta 50 and buying the delta 30, right? So like 20 delta spread between them is usually like a safe, you know, median to at least look at when you first pull up an option chain.
Okay, so you're saying you would sell it 20 deltas less than the at the money, which is always going to be 50.
Or more. I'm just saying, like, usually
at
you want
least
to keep
that, okay.
you want like an ideal spread if you wanted to keep yourself tight would be like a 20 delta spread, right? Like that would be
Yeah.
considered a tight, I mean, tight spread, not all too much risk associated.
Yeah.
Spread between contracts.
Yeah,
Between the long
Between
and
the
the short.
deltas of each contract. So it's like
Yeah.
whatever the delta is of the one you're selling minus the one that you're buying, like you'll see like, okay, it could be delta 48 and delta 36, right? That's
doesn't have
a
it.
wide delta.
Yeah, and unless he doesn't have it up on the screen yet. So normally what we were looking at before, I know probably before you got in here, was three, you know, basically three contracts, right? So selling two, buying one. But what he's talking about is between the one that you buy, right, and then the put that you sell, basically. The amount of deltas in between that was that 20.
Right, like you'll see like when you click like buy a certain option contract, right? There'll be a delta to that contract, right?
Yeah.
You're looking for a spread of at least 20, 20
20 wide, right,
basis
on the
points.
deltas between the contracts.
So, I mean, look, if it's
You're more
just a
concerned with
spread,
the-
right? This is let's just take this, right? So your current price is 200, right? Your current price of the stock is 200. If I'm willing to go out to January, I can say, you know what, the likelihood that this company beats again is pretty good. So if I've done my homework on the fundamental side and I know the story to be fine, then I just have to find, this is my more expensive strike, right? So this is going to cost me 22 bucks, 24 bucks.
Right, and you're buying that.
So
That's why it's on the top side. Yeah.
So yeah, so this is the long, this is the short, right? If
Yeah.
it's just a call spread, right? So this is a 2-to-1 risk reward, which is not bad, right? Let's move
But
it
your
up.
chance
right?
of profit
This is
is
this is almost a 2.7 to 1, right? If
Yeah.
I narrow the spread. So basically you're buying a 230 call, you're selling a 250 call for the same date, right? That's what a call, call debit spread is.
Yeah.
Now the cost of this is 600 and I don't want to pay. What is the way to do that is to, add another, another short, right? And I don't want too much credit either because, that would,
we were looking at 150, I think, was that
something
level,
like
but
that. But I was looking at a wider spread.
yeah, or I'm just that was just the strike we were looking at. So I mean, hey,
Let's just look at this. We'll adjust. Anyway, this is simple enough, right? So now instead of 570 bucks, I'm getting paid 260 bucks, but I should be prepared to buy it for 16,000 minus my credit, right? 15,740. If I
Into the
don't-
chance of profit. Look, wait, just go back real quick. Look what happened to his chance of profit, right?
yeah,
By
jump.
selling that 155 put, he now
let
has a
me take that out for a
75%
second,
chance of
right?
profit.
My chance of profit just on the call spread was
Right,
30.
it's like 30%. Yeah, that's fucking crazy.
Yeah, so it was actually, let's bring it down, right? This is what we saw before. 230, 250 call spread has roughly a 2.7 to 1 risk reward.
Yeah, risk reward's nice, but not the chance of profit is not.
Monetive,
Though.
move the 280 call to 250 though, you said, right?
Yeah, I did.
Yeah, you did. Yep.
Okay, cool. Yeah, it's updated.
Is it lagging for you?
Dad, you're good though.
But wouldn't it hit those prices?
So, okay, so part of that is experience. Part of that is trying to find where there are the first thing is, it doesn't matter if you find a great profitability trade if there's no open interest in that, right? This one looks like it's available on both sides. I don't see any warning, right? I still have to go to my brokerage and, check this.
Yeah.
But for January strike, it looks like doesn't have a December, unfortunately. So I'm going out. So anyway,
To answer
I
your
would just-
question though, is that, the thing is what he's aiming for, right? You do want to know, you kind of want to have an idea of where the stock, what the price of the stock's going to go to, right? So
Which
the
is-
thing is,
yeah.
you're buying that 230. So the closer you want it to go to 230, right? And that's why he wanted the 280.
So the
Have
reason-
you guys
no,
have
the
you guys ever
reason why I
heard Data
said-
and I? Have you ever heard Data and I explain like the thesis, like the explanation about how you should start an options contract with the sentence, like beginning with the thesis of what you have in mind? Like, I'm betting that by January 20th, right, 2023, I believe that the stock price will be between, right, like
230 and
X
250.
strike and the other strike, right? That's the way you
That's how
really
you
have to
pick it.
walk into each options contract, because
So-
otherwise
so,
you
but-
really just,
but
you're just
Anu,
picking.
But Anu, you have to remember, I didn't pick it on random. Look at the chart.
You did exactly what I was saying, right?
Yeah.
Like you have a fundamental thesis on where the price should
Yeah.
be.
So look at how many times it's bounced near that 230 level, right? Ever since April 2020. So right after the pandemic, it's been bouncing off that level.
Right.
So I
Yes.
think the likelihood that it defaults back above 230 is pretty good, assuming that I've done my fundamental study well, and the fact that they are projected to beat again next quarter. I think that is a fair point to start, right? So that's why I picked that near strike. The far strike is like Brennan just said. It's, you don't want to go too far out because then your cost is going to go up. I mean, look at this, right? Now it's 57. I mean, this contract costs $5.70 times 100, right? If I move this out, look at that, your
Goes up.
cost goes higher because
The
short
farther,
call
yeah.
is going to bring you less money.
Right. The farther out the money, the call that it is from the strike, obviously the less money it is.
The trick is to look at the break even right over there, right? Your
Correct.
goal is to like see this breaks even above 235, right?
Correct.
So like when you're structuring the trade, just make sure that your payoff window, right, that you see over there is within the range that you believe the stock will be, right? Because like if you move that 270 call up to like 310, right, you'll see the break even, right, changes dramatically. Right. That's what that's doing. And a lot of that break even is determined by how much you're getting in premium for the contract you choose to sell.
Yeah.
Yeah.
So you get, so let's say you moved it all the way to 310, you get $4 for selling that call, or $5, let's say roughly. Okay. Versus if you sold a 250, you would make $14. So you get paid $14.50 on this call, and this call costs you $20. The difference is that.
What the fuck is that shit?
Somebody's got a hot mic. Hold on. You guys, I'm gonna mute everybody, and then or I'm just gonna mute. You can unmute, of course, if you want to say something, but just yeah, there you go. I think we're good.
Okay. So anyway, so it's not blindly picking a level. It's finding where, where the stock has repeatedly bounced off and where the stock has repeatedly failed, and then bringing it back mentally and saying, okay, these are my numbers that okay, you need a starting point. Okay. 230 seemed a safe starting point for me because it's bounced so many times around that level. Okay. Once you pick that, then everything anchors off that, right? You don't want to pay too much. You don't want, you want to get paid as much as possible. You want the likelihood within the period you have. What is that? 1, 2, 3, 4, 5, 6, 7, 7.5 weeks, or no, 9.5 weeks that it get. Oh, it's more than that.
Right, because you don't have December in there.
December,
but it's
it's
3-4 months
quarter.
basically. Yeah.
You have full quarter, right? Within a quarter, the likelihood of moving, right? Look, your profit is capped. You cannot make more than the difference between these two plus the cost, right? So the difference between these two strikes is $20. Your cost is $5. You cannot make more than $1,400 from this trade. If it goes to 410 and you've not closed it, let's say something happens, they get a buyout for $400. Okay, it goes to 400. You can still only make 1430 because your call will be at a ridiculous profit, but your short will be at a ridiculous loss with a delta of 1430.
Yeah.
So this is capping your downside. That's all you're doing here, right? Is basically saying the maximum you can ever lose is $570.
Even though both of those are calls, one of them, the 230 is a call and the 250 is considered a put because you're
No. You're selling. It's a call,
Okay,
but you're selling that.
basically you're selling them the right. You're selling a call. So they have the right to call that from you at that price. So you're selling it to them at that price, but because they have the right to call it from you, right?
Yeah. Imagine like when you buy a call.
So when I trade
money,
options currently, I do buy to open and sell to close.
Right.
So
this would be sell to open is what it would look like.
Yeah, you do a
That's
buy
what
to
I was
open.
asking.
Yeah.
Okay.
So you can see that, right? This trade is buy to open a 230 call for Jan 20th at $20 and a sell to open, which is that negative -1.
Okay.
A 250 strike for $14. This is a credit. This is a debit. The difference is your cost.
And you'll do this
It's-
together,
it's
you know what I mean?
Being
This whole-
willing
Yes.
to buy the stock at 230 and agreeing that you would sell it at 250, right?
Yeah.
For
Okay.
the agreed upon premiums. That's basically what those strikes say, right? Because you have
Which
the
is
right
why it's
buy and the
capped.
right.
Yeah, which is why it's capped, right? Because it makes sense if you're like saying, hey, I will buy this at 230, but I will also in the same, in the same stroke, sell this at 250, right? So it's like
That's
That's
why
why
you
keep
that's
cap
why
it
it's
at
capped.
max.
Yeah,
Okay.
exactly. Yep.
Now that makes sense. Thank you so much.
Correct. No
That's why I
worries.
like to keep the sentence in mind, right? Like I would be willing to buy this date, buy it at 230 and sell it at 250.
Yeah, and some people actually write it out, like literally will write it down or type it out and then, and rework it. I mean, eventually you can, but I mean, that's how it was taught to me was to literally like write it out as a sentence. So
Yeah.
it's the smart way to
Hey,
do
can I
it,
ask you
man.
guys a question? What's the odds of somebody executing the trade?
What do
You mean actually getting filled?
Yeah.
You
Well,
mean
no,
like,
exercise, not executing. Exercise. I'm sorry.
Okay,
No,
so
you-
assignment risk you're talking
Yeah.
about, right? So, okay,
Yeah.
if you think about it, right? If the trade requires no margin, if this trade if the 230 call, right, were to be exercised, if it were in the money, right? Right? You would have to exercise it, sorry, right? If the
Yeah, I hear you.
250 call that you sold got exercised, right?
you already have the
own it
230.
at 250,
Or
at 230. Right,
230,
so
yeah.
that means exactly what the contract says. You would have sold your 230 shares, right?
At
That you bought at
250.
230 at 250.
Which
Now,
is your premium.
which is your goal, right?
Your profit.
Similarly to a covered call, that's the strike you'd be selling that covered call at, but you don't own the stock. You're just buying a lower strike call in
You're just
place of owning that stock.
Right, and it makes sense, right?
Gotcha.
Because if
Yeah.
if the 250 goes and gets,
Your
if you get
question
called
is
on it.
why I took an extreme example. Let's actually answer that question with an extreme example. Let's say 1 month after we buy this call spread, the company gets bought for $400. Okay. So somebody
Yeah.
buys MongoDB for 400. Immediately, the person with the short call, right, is going to say, I want to excise it, because they can buy the call from you at 250 because you promised to sell it to them at 250.
Yep.
And so you are going to, if you didn't have this short, your broker is going to take the difference, $150 difference, and he is going to, sell you that, he's going to pay that, right? So that would be the loss. But now what happens is if you get an excise request for the 250, you immediately tell your broker excise both sides of my contract and give you that delta, which will be this again.
Yep, it'll be your profit. And that's
Depending on the time, it might
Now,
not exactly be
this is
this.
why it's so important though that we make sure we sell a strike that's expensive in premium, right? That we a high IB, because we want to receive as much in premium for that 250 call as we can, right? So
Correct.
that when we buy that 230 call, let's say we get $5 in premium for the 250. Our cost basis, even though we have a 230 strike, is now 225 per, right? So if it were to go to 230, we still own it at 225. Right? Because we received $5 in premium for the short call, right? So like, that's why you want to make sure the one you sell is getting you as much as you can in return, right? Compared to what it would be worth typically, right? That's why expensive IV, like an IV spike, you would want to sell that because you're getting more in exchange than its fair value, maybe you could say, right? In order for you to buy the strike price you want at a cheaper price.
So do we set the sell of both of these contracts at the max profit limits when we open them?
No, so you can open this as like a vertical, right? Like is what, like, I mean, you can basically
you're gonna do it as one.
right. You can
Right, you're
open
gonna
the
do
two
it
of
as-
them up together. It's sell to open and add another leg, buy to open.
Most
right?
likely your broker. I mean, I know SJG, your broker is, just from talking with you about your situation, you wouldn't be able to sell that call naked, right? You'd have to open this up as a spread. Like they're not going to let you sell a call naked because of the margin
Right.
requirements.
They
of the
know
level.
they know your maximum risk because they know if it goes right above 250, your 230 call exercises, right? And then you sell it at 250, they know what your maximum risk of the underlying shares possibly is, right? And if they would never let you take risk that your bank, your account or your brokerage couldn't fill, right? Like in the amount of cash you have, right? Unless you've personally requested that margin or that approval. Because at the end of the day, if that was to happen to you and they were to margin call you and you did not have enough money, right? Like if you sold at
Right, they're
250 and it
done.
went to 500, right? They would be the ones on the hook, right? So that's why they basically
So my
limit the right
brokerage
to
would
margin.
protect me from
It
making.
wouldn't let the, it would
Yeah.
deny
They're
you the right
protecting
to take that
themselves, yeah.
trade without a protective leg, like being short
Yeah.
one and long one. That way your only exposure risk is the delta between.
Yeah.
Okay.
Listen, let's and so Monetive, I mean, do what you're doing, but let's move on to where, or keep going to where you add on the put though, because I think that's,
So anyway,
I don't want to just get too
let's
focused on just this.
So let's make this okay. So roughly 2.7, 2.67 to 1 is the
Risk to
the
reward.
upside
Yep.
to the downside risk reward, right? But my probability of profit is pretty low. It's 35%. Okay. Unless I know something about the company that the world doesn't know, that's not enough risk for me to take that trade. Okay. So how do I change this? I can move these, right? That's the standard way to do it within the existing structure, right? I can move this down, right? As I get closer to being in the money of this call near the current price of the strike, the probability increases, but my risk reward is messed up now. Instead of 2.7 to 1, it's now barely 2 to 1, right? It is 2 to 1 and my cost goes up. I don't want to do that. So what choice do I have? I could, so in this case, the simplest would be I do another short, right? This is already a short. So what I do is I'm going to sell a call all on the same date, right? The strike date is the same for all legs of this option. So I have to find a strike where I get a credit instead of a debit. Actually, this is too much credit. Where do I go? Sort of. Okay, this is.
Yeah, and look at the chance of profit rock up, you know.
But these don't. Okay, let's leave it here just for the heck of it, right? So because I don't have much open interest in these, so it has very low volume. So let's leave it here. This is just a theoretical example, so we're not worried about that, right? So what I'm doing now is going from, remember, let's take this out. Remember, my cost is a debit for the call spread, right? Buying a 230 call, selling a 250 call, it costs me $570 plus brokerage. Now, when I short another leg and sell a 150 put along with it, it goes from a debit to a credit. Now I get paid $600 to do this contract. The probability of profit has gone up dramatically, but what has happened now is this column has changed 100x almost, right? From 500 bucks to, what is it? 30x, sorry, 500 bucks to $15,000. What is this, right? You need to understand first what this is. Okay. 150 put, you have sold it short. That means somebody can force you to buy the stock at 150. Let's say the stock
sold
goes
them the right to put it to you, right?
correct. So let's say the stock price goes to 120 or 130, they can force you to buy it at 150, right? But you've already collected 600 bucks credit. So the difference between the strike price and the credit is your max loss. That's a theoretical loss, right? That is assuming you're forced to buy the stock. So this max loss is the difference between the short put,
which you could then just sell as well. I mean,
Right.
you know, that's the,
you will always manage this separately.
It's in theory that you're forced to buy it at 150 and it went to 0, right?
Right.
That's what
Right.
that max loss means. Because
Exactly.
if, let's say, this tanked all the way to 0, on its way down, you have a short put, right?
Yeah.
That if somebody knows they own a 150 put, right? They have the right to put that stock to you at 150, which means you'd be buying it at 150. But your cost basis on that purchase would be 150 minus the amount of premium you received per contract. So if you got $5, right, or let's say 605 per let's say, yeah, that would mean you got $6 per share, right? Because it'll be times the 100 underlying shares, right? If you got $6 per, your cost basis would be 144 by buying it at 150.
Yep.
Yep. So, and the thing is, like, I mean, that's why obviously, you know, that max loss is, I mean, it's exactly what you just said. It's assuming it goes to zero. Now, I'm not saying nothing can go to zero, but I mean, these stocks, you're not gonna, you have time, right? So it's not that you wouldn't take a loss, but even if it gapped down, you know, $10, you have that, what was it? What did we say? $6,
If
right?
you owned
per,
the stock
you know,
and it went
right.
to zero, you would also lose every dollar.
Exactly. Right.
Yeah,
Yeah.
that's the theoretical loss if the price is zero.
Yep. So it's and you know, that's, don't let it scare you, you know. I mean, it's
Yeah, but why are we doing this, right? So one, your probability of making a profit on this on this contract, you know, jumped more than double, right? From 35% to 80%, right? 79%. So more than double. Okay. So why are we doing this, right? So your short, your long call, which is the only long you have in this contract, cost you $20. Your short call paid you $14. So that delta of $6 is made up by this, by getting, you get paid $12 on this. So that's the difference. That's why you have a net credit of $600. So if you add it all together, you get paid $600 to take this trade. Now, the best thing you can do very simply is you can, let's say we did our research correct, and tomorrow or next month the price moves to, let's say, 220. Okay. If the price moves to 220, this put will now be less expensive. So you can, since it's a short.
Monetive, can you switch to the graph just for when you're like discussing the tomorrow, because you can
Sure.
change the day on it really easily.
Sure. So where are we? So let's say November 1st, just for the heck of it. Okay. So let's say November 1st, the price is 210. Okay. If the price on 210, if the price is 210 on November 1st, your contract is, you are going to make what, $200 on this? Is that what I'm reading, Brian?
Making less, no?
527. It's whatever where it is on the green at the 209, you would make 527.
Yeah. This number here, right?
Right. But then if you just extended the date all the way out, you would watch that line go up to move up to the dotted line, right? As that's just the time value. Yeah, the dotted line is at expiration. The curved line is at the date you've picked.
Correct. So that is your max profit, right? If you wait all the way, your calls, your long, your two shots expire worthless. Actually, no, not if it's 270. Let's say, so you have a 230, 250, right? So let's take the best case scenario. It expires at 248. Okay. On the last day. How do I see that, Brian?
well, that's the dotted line. So
Yeah,
I know,
you can
but
move.
you'd have to move the date.
Yeah, the middle bar, like the curved bar is just is like at expiration, right? The right now, if you wanted to move the date bar on the bottom, the blue one, over to the end, you'll watch this as you drag it along. You'll watch the payout change, right? So to see today, you would just drag the blue bar to the end.
Yeah. So you could move the price up on the graph over to 220, I think is what you're talking about, and then just move the date bar back and forth.
so let's say, okay. So if the price is somewhere here, when the between your two strikes, when you sell or when it expires, then that's the profit you'll make. You'll make $1,600 from it. right? You're making $1,000 more, plus you already collected $600, so your profit is $1,600 on the trade, right? And what happens is, if the directionally the stock is moving towards you, your call, the premium on this starts disappearing, right? This becomes worthless as a short to the person that sold it to you. So your margin keeps getting lower and lower. As it comes towards you, your margin that's being held for this short disappears. So by the time you get here, you don't have to do anything. You just collect that, you just collect that, right? This call expires worthless. You got $1,000 for it, or $1,100, you keep it.
Would it make sense to buy that back at any point?
Sometimes.
Okay,
sometimes, right? So let's say it's moving slowly, but it's moving in your direction. You don't want to hold that margin anymore. You might just sell it and take the credit.
Yeah, absolutely right. And if it pumps up in price, well, maybe then you close everything. But say it pumps up, but it doesn't put your calls in the money yet. You could unload that put while it's pretty much worthless.
You always want to watch that, because that's margin, right? And risk. So you always want to watch what is happening to that.
Right. If you sell that 150 put and this thing starts to rally, right? That 150 put becomes worthless, right?
Right. Yeah.
So at that point, you want to try to buy that back, right? Now you've basically bought back the credit you received. So your risk on having sold something, right, and received credit. So sell to open, buy to close, and now you're left with just the trade, right? The 250, 230 call spread, having captured all of the premium they gave you, right?
Right.
For nothing, right?
From that,
So
absolutely.
That's also the goal at the end of the trade, right? Is when you would sell like a spread, buy like a spread like that, is it would either expire like right in your price range, right? And if it does, whatever you sold short, right? You sold for $7. If you hold it to expiration, right? The goal is that will expire worthless, and
Sorry. Yeah. No, it makes sense. I just wanted to ask because I wasn't sure if it would screw up your like if it would screw up something with the the call spreads. Is all. But
that's genius, Brandon. This is the first time I had somebody explain this shit to me, and it's genius. I like this. I appreciate you guys doing this.
So
I really do.
Who's talking?
Mills.
Hey Mills, I want you to be very careful, okay? I'm not anywhere near as smart or as qualified on options as Brandon is.
Listen, Monetive,
which is hold on.
Smarter than me. You're smarter than me, Monetive. I'm watching this right now.
Hold on.
Like,
I'm trying to make a point. Hold on. I use a tool to help me find the option, find a place to start. Then I can catch up on my own, right? That's the value of OptionStrat to me. That's what I was getting to, right? So somebody like somebody like Brandon or my friend Archana or Nargis you've met or you've heard her on the call, they can actually calculate most of these because they just have done so many of these and they've studied this well enough to understand the concept behind how these are priced. Right. So with enough time, they can come up very close to the optimal trade. The only difference is this package like this is programmed with all that in the algo to give you, choices. It might not be perfect, but it'll get you close enough. For me, that is plenty, right? Because I cannot do what Brendan does. I need a starting point.
This is all new to me. Like, this is all new to me. So seeing this side of the option chain is just like, I didn't realize there was a lot more to it and the value to it. So I'm new. I'm not like I'm a year deep into the
no, and Mills, that's what this is kind of what I was alluding to in the very beginning. Is that this, like, getting into this stuff, like kind of starting to understand it, it forces you to to kind of learn the back end, right? You're not going to learn everything. It takes a while. Like, you don't have to understand it all right away, but what it does is it makes you start to think of options in the way that they actually are, right?
Yeah. Can I just add in? Can I just add in? OptionStrat for me is even more, is like everything Monetive just said and more. And like, even as advanced as I may be, and what he is saying is true, a lot of times, like for me, what it's doing is it's allowing me to, like, when you think about like how convicted you are in something, right? It may be the thesis playing out, it may be like the fundamental of the company, right? a lot of my edge comes from understanding this, right? And the way options move are priced, right? The math behind it quicker and or more effectively, I believe, right, at times than others. And it's not then the market maker, because that would be silly, right? It's then the other person that may be in the trade as well, which is why I like to often say like sell expensive IV, right? Things like that. But for me, I learned the most by literally going to a tool just like this and hitting save trade, right? And then when you save it and you're my account, you have your saved trades and it saves it from the point you saved it, right? All along, and it shows you the performance of all of them as you go, right? So basically, like you can start almost like paper trading, but it's more as the days go on, right? You're seeing how it's performing day by day. And if it's kind of, going along like the path you thought, and you still like the trade, right? You've saved exactly the point of the trade, right, from your thesis, and you can see how it's performing, right? And you can start to track yourself on your own, like, how accurate would I have been? Like, what should I adjust before I go and actually, make some of these trades? Are they performing well? And then the coolest part about like that save trade is any of the flow that comes through on OptionStrat, as it comes through, right? You can click on it and it opens it up with the ability to save that trade. So like you could start kind of understanding like how these trades are performing that are in massive size being booked in real time, like using flow tools over time.
Let's look at that. So let's say,
but that's great. That's great. I'm sorry, but that's great. I appreciate you guys.
Yeah, let's look at the example he said, right? Okay, this is a call spread. This is simple enough. Okay. So somebody put $635,000, or what was it? Sorry, $120,000 into this. Okay, that's big money. Somebody's betting that directionally this is going to be right. So what have they done, right? They have bought a 287 call for this Friday, for tomorrow. Yeah.
Yeah, hit open the advisor too. You'll see, because like it's a lot more surprising than most people realize, right? When you open these up, you'll see that a lot of these trades are basically profitable right now and above on the bullish side, right? Or from spot below, right? And they're really designed as massive in size, right? But taking advantage of simply the price of the premium that they're using in order to get themselves and position themselves in exactly the thesis that they have, right? So when you open a visualizer, right?
Look at the risk reward, right? By spending $26, your max loss is $26 on this trade per contract, but you could make 10x in one day.
And if you look, right, the break even 287.26, right? And this is October 7th, right? So this person is betting, and this trade is up 3.8% since they took it, as you see on the top, right? It shows you from the returns from when they took it, right? So that's one thing to know, right? But also, this is just a bet in massive size because of the premium amounts that gives him the ability to 10x his returns, right? Betting what is this, SPY?
You make $1 million bucks.
Moves, it makes a 10-point move, a 2.7% move in the Qs makes him 10x 1000% gains.
Yeah,
right.
He'll make $1 million bucks.
The break even is 287.26. That's a plus 2.7% move. If by October 7th that happens, right, he will 10x his $26. That's what this trade is truly saying. So when you see some of them come through in the flow, like, and you view them in this manner, a lot of times it says a lot more like than what just it appears as it's coming through.
So in a sense, if this particular spread, it's not going to reach that strike prices, and that's how this person makes the money.
If it goes above 726, this person makes money. So if he went on the bottom left, there's a blue bar that says chart range, right? See how he makes money at a 2.7% move or greater. This whole chart range is only showing us 2.1%. So he loses money no matter what, right? If you widen that out, you'll see there is a range he makes money on, right? So this person has paid $26, right, per contract, right? So if he took it in, there was an amount he bought, right? If it was probably like 1,000 of these, right? So if you went into positions and edited that, it would be this times 1,000, right? Or times 100,000. But it's still $26 to make 275 on a 2.7% move on QQQ. That's like the
Yeah, that's
thesis of the bet.
crazy.
This is
Yeah, that's crazy. That's good shit. I like it.
Yeah, so you guys have to remember, right? Professionals don't bet on one side of the contract ever. They need to know that if they're betting $1 million, that is their total loss, but their profit is probably 20 million or 40 million or 100 million, right? So they can't take an open bet and say, you know what, I don't know what my probability is, right? If you take this away, for example, right, if you remove that, what happens? Your profitability percentage goes down, your loss increases, right? So the cost of this contract for them would have been much higher at a lower profitability, which is why they added this 290 call, right?
you can, by the way, Monetive, you can hit exclude when you right click on it and it just hides it temporarily.
Okay. Okay, got it. So Brendan, this I've not even thought of this. I'm not that new to this. I mean, I'm pretty new to this tool. I used to use options play, but that subscription expired for me for a weird reason. But that's a different story anyway. So this is a great idea, guys. You know, you're looking at live flow. You just click and see exactly what they did, and then you open it in visualizer and it gives you the same information instead of, so you could basically copy the trade of some big whale exactly to the
Yes.
to the dot.
And understand exactly what it is the trade they made without nearly as much assumption, right? We don't understand what their book is holding when they make these trades, right? They may have sold the same amount of of TQQQ, right? But just in size that made that trade what they had to do in order to hedge their book, right? But still, when I saw that coming in flow, and I saw 168K in premium on, a spread that pays out, that's a 1 DTE, right? It seems like who the heck is paying, right, $100,000 for betting that, right, like on that by tomorrow, right? And then when you see that it's truly $26 per contract, right? So someone's betting $26 to make $275. That if there's a 2% move in the Qs, right? The way that trade works. It's a lot different than the risk associated with not viewing, right, the actual payout by the day.
So what was that big trade, right? It suddenly came up in the discussion today. There was that 16 million trade. Let's find out what it is. That would be a good trade to look up. There you go. Okay.
In fact, I did this today and I hit save on it so I can track along how it's going to perform, because it will say a lot if it doesn't move all too much over time, that it's much more of positioning a big book.
So this trade is not explained by the risk reward, right? This trade has something else that we don't know about it. Right? I mean, somebody is betting one side of it with very little chance of profit, already losing money, and with a large potential loss. So what are they betting on, right? Of course, there's a little bit of time to this, but it's interesting. So it's a way of looking at it, guys. So basically, right, I think simplest part of what Brendan said is, though he can get to this saves him all the time in the world to get it, and it provides him the chance to, change it and see if there's something that they missed that he could figure out himself, or backtrack and figure exactly why they should have picked this, right? By changing things.
Exactly. That's exactly right. Right. Like what could they have even done better? Right. And even, or like what situations maybe would I have been in to be taking this trade, right? It makes me understand a lot more, like when I see unusual flow versus like flow that you'll see, like if you go back into that flow list, like, right, the feed, some of them you'll see in there, right, that look like ridiculous also. They have 1.6 million in premium, right? But if you look, if they're a spread taken, a lot of them, even by like January expirations, right, they end up being a bet that basically Apple will move up by 2% by December or January, right? And they make money in between a 5% down move and a 7% up move, right? Like that's what those spreads are often designed to do, right? If you do a calendar and and you see one of those, right, you'll see that they're basically betting just that it'll be between this strike and a big wide move by next year, right? And if they're holding a book, right, and they're managing money for someone for years, right, that's their goal, right, is to ensure that they have the right to buy this much of this equity, right, by that date, if it moves up 5% or down 5%. And a lot of these moves are really just, right, they're positioning to be able to get exposure to bigger moves, right, with smaller amounts of their book, utilizing the leverage.
Yep. So, yeah, I mean, and it can, it can get complicated also, right? What is this?
No, this
So
is
Brandon, do
great.
you follow any of these trades that come up on the book? Like if you see like a,
Tons of them. In fact,
a spread coming in.
like there's this one Pfizer trade I did this exact thing on at end of last week. It was like massive. So I hit save on it. I was like, it came in as unusual, and it's up 100+% and was up 50 some odd percent today, right? When
Did you
you're
follow
when you
that,
know the
Dennis?
thought, like I followed it, I didn't follow into it, right? But like I don't
But
ever
you looked into it,
necessarily
yeah.
follow
Watch it.
into trades. To
But
me,
you
it's
watch it.
trying to figure out if like, yeah, I watched it, and sometimes it's trying to figure out, did someone know something, right? Or if I was thinking something similar, right, at a certain time, right, and I see flow come through, and I'm like, that's a trade. Oh, I was looking at the 350-400 bear spread, right, like that, yeah. And I see it come through a couple times, right. I'll see maybe in size it done over a different spread or different strikes, right. And by saving it, like I see how that trade, you know what I mean, compared to my trade, right. And it's basically like, like journaling, right. I keep all the trades saved as a journal to compare my, you know what I mean, decision making and process against those of the biggest size, right? But not just looking at the spread, right? But looking at it within the visualizer so I can see the spread, so I can understand, all right, their bet, right, was 12% more performant than mine, right? That may be true, right? But they were able to take, $3 million maybe of margin, right, on a massive trade. To me, that's more than fine, right? I'm like more than accepting of my performance if that's the case, if I'm still positive, right? But if I see that, like, if I had sold a 370 and a 390, right, and bought a 380, right, and done a butterfly instead of the bear call spread I did, right, and that doubled my performance. Well, next time I go to set up a bear call spread, I'm probably going to also look at what that other, right, like the last time that a certain strategy worked better than mine, how that might perform in this trade better, like, instead of the type of trade that I have. It's oftentimes is comparing what I would have thought to do in that situation comparatively to what the trade that I saw come through was, right? Like we often laugh, like we're like, oh my God, what a ridiculous trade. And then you're like, wow, they actually made that, like they were right and I was wrong, right? And like we often don't give that a lot enough credit.
So I have to say, hold on one second. I have to say something here, okay? So you have to remember, longer term, the amount of intraday, the width of the intraday moves that we've been seeing for the last 3 years, it is not normal. So you cannot continue to make these day trading trades of 200, 300, 400% when things revert back to an unskewed normal in the market. You have to take longer risks and you have to balance those risks, and that's why that's why these trades are all about balancing the risk and still keeping the risk reward enough that it's worth taking that chance. So once your volatility falls back to mean, you're not going to be able to see those $3, $4, $5 moves on dozens of stocks that you guys see every day in the room, right? Those are not normal. You guys have to understand that this is all the last 3 years is not normal.
No, it's way
right?
out of whack.
It could go, right? Let's forget the .com, right? Let's say 2005 to 2000, let's say 2004 to 2006. Most stocks would barely move 1% every week or so. They just barely move, right? There would be stocks that move. Your indexes move, a few points a day, right? When that happens, it's very difficult to make money by buying, few days out calls or zero DTEs, right? Zero DTE is not going to pay at all. That's when you need to get into more complicated option strategies where, whether it's directional or you're going to, you're just harvesting, the volatility and making money irrespective of which direction it goes, as long as it stays within a range, right? Those are all where you make money over time. So, and historically, option buyers have always lost money compared to, or rather, no, I shouldn't say that. Option buyers have always made less return than option sellers historically. That's just unfortunate truth. It's just the way it is.
Which speaks numbers to how much like greater percentage the win rate is on selling options versus buying,
Right.
because in selling an option, right, there's always a maximum profit, and it's always capped at less than buying would be, right? Because if you're buying something, right, on the long side, the upside is limitless, right? When you're selling something, right, a premium, right, you're collecting premium, right, in harvesting it. You're hoping to hold on to that, right? And in the assumption that it does not reach, right, the desired.
Yes, and every day that premium burns away, right, by time decay, right? You want that time decay to work in your favor as a seller, right? As a seller, every day the time is, the time decay wastes away the premium of the person who sold it to you, and you keep all the money you made on, selling that premium, right? Who, I meant the person on the other side, that your buyer, not the seller. You're the seller, right? So the point is,
Absolutely,
yeah, the point is, this, what you guys do on a daily basis is ideal for the current situation for the time, right? So absolutely the best thing to do is continue as long as it works. But when you have time, take the time to learn more complicated option trades. Why you don't have to build it like Brian said, right? You could just, whether you have a tool like this or even within TOS, there's lots of ways to save paper trades, right? You can paper trade all of these, save the trades, see how they go, understand what it is, right? So you have to understand the Greeks, you have to understand how these trades get put together, right? What do each of these mean? Why or what strategy is applicable to what situation in a price cycle? Once you understand all that, right, you can make a good income with very minimal risk of capital and very minimal drawdown by just selling options regularly.
Yep. Think about what it says, right? I'm selling options premium, right? The premium someone pays, right, to take the bet, right? That is like, it's basically like saying I would like to be collecting the VIG in a casino as the bookie, right? Instead of having to take the bet on one side of it, right? Oftentimes that is what, and it doesn't mean selling an option naked, right? Selling an option spread, right, is being that, right? You're collecting the premium, right? Assuming that you obviously have it, right, like it matches your thesis, but you're, instead of buying the premium, right, you're spending money in order to take the trade. You're receiving money in order to agree with that trade, right? Is oftentimes like, a simple way that I like to put it, right? It's not me just going, yeah, I'm going to sell that, right? And like, I'm going to bet against that. It's all, a lot of the times by selling that, right, I am actually betting on it, right? But just way less than someone else's, right? Like it gives me 5% to the upside room, right? But like also 5% to the downside. And like I just saw, there's a good example. Monetive, if you want to click on the $3.484 million SPY straddle right there, I was just looking at this myself, right? So when that comes through, right, you see that and you're like, okay, like that's a big one, right? That's a 3.8 million on SPY, right, for October 21st. And then when you look at that trade, in like in the visualizer, right, you see that the person is protecting themselves against basically you could think about it like the Fed pivots, right? And doesn't raise or raises a lot, right? Because they get paid out if you spread the chart range to more than like the 5.7%, they get paid out outside of 345 and 384. So if it's below 345, anywhere below 345, right? And anywhere above 384, they begin making money, right? So I believe it's just not going to be, it's not going to stay right here, right? We're going to have volatility. Unsure which way, but then we're going to have volatility, right? And for that, this is a $1,922, right, risk per contract, right, for a max profit infinite, right? That's what I was trying to get at before, is that like, this is still a bet in the long side, because anywhere above 384, you're making unlimited money, right? But you're also protecting part of yourself, right? Where if it goes below 345, you're also making money.
Hey, Brendan,
Right? And this
I don't
has a
see that.
40% chance of profit.
Where do you see
On the
that?
bottom left, if Monetive moves the chart range to be more than 5.8%, right? You'll see that you start making money on the downside again as well.
Okay.
So this part is the only time when it costs you a maximum of $2,000, 1,922. If the price stays between these two levels, right, 345 and 384, anything outside of that, look at the profit going up, right? Can you see that?
Mhm.
Consider it to yourself, like, would I be willing to, if I knew it was at 385 and going nowhere but up from there, would I be buying? Well, I'd be buying, right? But would I spend $1,900, right? Instead of, if you look at what just the calls alone would be, right, somewhere near like probably $2,800, right? I'm spending that instead,
Okay.
right? 1,900,
Okay.
and I'm protecting myself from the downside. This gives me
Okay.
the right to basically.
Okay, compare this to if you bought a call and a put. What's the comparison if
This
you're
is buying a call and a
oh,
put.
it is buying a call, it's not selling a
Yeah,
call.
right.
No, this
So,
is
but
not
the
even
thing is,
selling.
so you're buying, yeah, you're buying both of those in a straddle, right?
Yeah, this is
Right,
okay.
right. I was saying versus spending the same amount of $1,922, right, on premium for just buying the 384,
Yeah.
strike, right? Because that's what you're betting on in this, right?
So instead of picking a direction, you get coverage on both sides. Does this, I'm going to say something goofy here just because I'm trying to understand, making sure I'm tracking. Because the range is like for, you know, bigger gains, you really have to go outside of those ranges, right? So is it fair to assume that, you know, kind of the high beta stocks will perform better with this sort of strategy? Or am I oversimplifying things?
No,
No,
that's
no.
exactly,
Think about
that's
that for a
exactly
second.
correct.
No. Hold
no.
on.
Go ahead.
What is a binary event with a hit, or you know, with the up or down thesis on a high beta stock, right? What these guys are betting on, like Brennan said at the beginning, is that when we get the what is this? This is 21st, right? So after CPI, right? Before the next Fed meeting, but after CPI, right? So they are betting that the CPI is going to either come in so hot that it's going to kill the market, or it's going to come in, you know, so low that the market is going to run, right? So that's an event that they think is not going to let the market stay where it is. It's going to move. They just don't know the
Right.
direction.
It gives them a pretty, look at that though, a 40% chance of profit, right? On with protection on both sides. And that's why this trade was done strategically, right? At 365, right? Which is in the money, deeply in the money, right? When it's 373, right? Designed to do so on purpose, because the 365 put, right, being in the money is very, very, very cheap, like dirt cheap, right? But it's the protection on the opposite side of the 365 call that gives this person, right, the ability to make money if that goes all the way down as well, right? If you tried to do this on the 375, you would need a way wider swing, right? Because you'd have to pay even more in premium, that you'd have to add that on to the move, right? These are deeply in the money, so they're cheap enough right, that the move is actually not nearly as massive as you would think, right? They're paying for the move from 373 to either 343, 345, or 384, right? By buying them at 365. So the IV on the 365, right, is clearly way less because nobody in their right mind should think that it's more likely 65 goes to 384 than 375 goes to 384, right? So it's just strategically done where if you saw, when you saw this come through, you were like, that's aggressive, right? Like that's $10 in the money from here. But when you look at it, it's much, much, much more protection, right, than it is anything else without, and like avoids the possibility of the market runs, right? And they weren't a part of that, right? But if the market tanks, they are also protected. This has to be a situation where you'd be willing to buy either protection to the downside or long exposure, right? Because it's a debit. You're still buying. You're just buying yourself a straddle instead of all the protection to all the profit to one side, right? If I bought 365 calls, I would hope that I'm profitable way before 384, right? But by buying that 365 put, it means I'm also profitable under 345.
Yeah, so going back to your question, right? What would be an example of an event that could move the stock up or down like a high beta stock? You said high beta stock, right? So let's take a high beta stock. First Solar, for example, is a very high beta stock. Okay. So before the Inflation Reduction Act was announced, that would have been a good trade to do it exactly this way, because it either ran because the Inflation Protection Act was announced, or it just
Guess
dropped
what?
because they got no benefit. You
On
would
the top right, there's a historical chart. You can actually follow this contract in relation to the move in the underlying back since the day that they actually listed the contract.
where is the, oh yeah, historical chart, yeah.
I just started using this like 2 days ago. I was like, whoa, it really helps you realize like how expensive or cheap something has gotten, right? Or gets based upon a move in the underlying.
Yeah, so who was asking that question? I apologize. I still don't know the voices, guys. I apologize. That's shame.
Hey, Monetive. Yeah, it's Digi. I was actually on my phone earlier, so I was on here as B, but it's
No,
same guy,
perfect.
same Digi.
So,
Yeah.
so Digi, so
Yep.
you understand, right? Why SPY makes sense around the time period where this trade was taken. Why did they do it on SPY, right?
Yeah, absolutely. Yeah.
Because of the CPI thing, right? I'm guessing there's nothing else. So I'm guessing it's related to the CPI, right? There must be some employment data, all that, whatever, right? But it's all related to economic data since it's before the Fed.
Do you see how much more we're discussing this trade in its actual, like, reality, like of what someone was doing by doing this trade, by what this tool gives you the ability to do though? That's why I find so much value in it, right? Like we're finding out what happens around this date of October 21st, right? That makes someone want to believe that it's either going way down or way up, right? That's a lot more knowledge than just seeing a 365 straddle having come through the.
Yeah, and that's what you don't get from Cheddar Flow and Black Box, is they don't give you the context of the trade itself, right? Because their part is to give you intelligence quickly enough for what you want to do with the trade, rather than trying to analyze the trade itself.
But can I ask Digi a question, right? Like back in August, Digi called out Oxy. It was I don't know, it was like $70 strike price at the end of the week, and it hit. So sometimes when they make these calls, does it work? Because I think Digi's on here
You can
now.
go back and look at any historical flow trade from the history in the historical flow, and you can grab it and see exactly how it did. By the way,
Well, no,
they're really good.
Digi, I was on Twitter and Digi, like I said, I'm new, so
Let's actually look
Digi
at
made
it.
a call. He made a call for Oxy at the end of the week for $70. So I bought it. It was a $6 call. At the end of the week, it was $135. So I'm like, do you guys follow these when these things come in, like when these spreads and certain calls or certain puts? Do you guys follow them personally?
So I'm new
Them
to
as in,
option
like,
strat.
as in,
Yeah.
like, take the same trade.
Yeah, because I mean, I took that when Digi made that. Like I said, I'm new, and it was in August, but it was a $70 cost. I mean, call for
Hold
Oxy to
on,
be at
Let's
70.
actually find that trade, right? Let's say.
Yeah. It was a. I think that's a 2,000%.
I
So I'm
have
like,
a
how
pretty
does-
straightforward answer. Ready? It's just I look at the trade, right? Because it's I'm curious either way, but it's basically it's an added like it's it's a person to bounce the idea off of, right? It's like if I had a similar trade, right? You hear it, you're like Oxy said our call. Oh, I mean, I've been thinking about oil lately, right? I've been thinking about buying that. Let me see actually what that trade looks like, right? That's where for me it is, right? It's not I'm gonna follow that person in just because someone in size made a big trade, right?
No,
It's trying to understand why smart money made that trade and what that trade looks like, so that if I like it also, I can participate in that.
Okay,
Right. But
let's
that's
look
what
at
I
this
said.
trade, right?
I bought one of them contracts. It was $6, and at the end of the week it was 135. And like I said, I'm new, but Digi called it out, and the option was so cheap. I'm like, somebody knows something. But I'm just saying, like, when you guys follow Backbook and Cheddar Flow, do you guys follow into it, or do you just like sit back and watch? I mean, I know you do, Brandon, because you said it.
I mean, I'll never blindly follow in. I'm looking for trades like similar to the trades I'm already looking for, right? Like this would be like I look at Oxy if I was and the flow on Oxy if I was looking at making a trade on Oxy, and then I would maybe, strategize my trade that I like similarly, right, to one of these. But it's basically just inspiration, right? It's like, all right, here's all the trades that have been taken on Oxy. Do I like any of them? Right, like the payouts. Do I like any of the payouts? Right. It has nothing to do with the fact that I saw it come through on Cheddar Flow or on OptionStrat, right?
Well, no, I just saw when Digi said it. Like I said, I work full time, so I put an earpiece in. I get on Twitter. I just hear it, and certain things stick out. And I bought one for $6. At the end of the week, it was 135. So I was like, do you guys do this, or like, I don't know. I'm just like I said, I'm just trying to understand the information.
I unless we see the trade itself, right? I can't tell you where it went up that much. I just picked.
No, this was in August, probably the first week or second week of August, and it was and I just know because Digi came out and said like somebody made a call option for Oxy to be at $70, and it ran from 62 to 71. I don't know. It was a $6 bet. And
did you take the trade? Did you take the trade?
$6? Yes. That's what I'm saying. But I bought it for $6.
If you look,
I'm on
look up the trade, like the time of the trade, we could probably find when the bigger
Brandon,
trade
I'm
was.
so new to this, so it's like go back and be cool. But like, I try to do it. Then give me a second. I'm putting.
DG, do you remember
Yeah,
what the question?
Regardless, I
Yeah, I
think
was
the point,
trying
the
not
moral,
to.
though. The
Yeah.
moral, I think, is just like that we don't just follow the trades, right? Like
Yeah.
seeing what the trade looks like, right, as inspiration when we're looking at trades of a certain ticker, right, is helpful to kind of gauge, right, like what others are doing, right, that are taking, options trades on the same name, maybe for the same date. When we call them out, it's usually because they're tickers of names that we like do trade often. So to hear or see something come through like that, it allows the others in the group or room to go and explore what they think that trade might have meant, what that trade looks like, right? And what they may do in response to that.
I was just new to this, Brandon. So it was August 16th. And that's maybe when I don't know, that's when I bought the contract maybe. But I don't know. It came through. Digi said it was a $6 contract. At the end of the week, it was 135. So I'm just like, who knows what and how do you know it? And so you can.
Okay, what was the contract?
Oxy $70 contract, and I think it was at 62, 63, maybe. But I just bought it at Monday. It was Monday, and it was a $6 contract. I like to swing trade because I work, construction. So I just plug my ear and just try to pay attention to a lot of things. But it kind of paid out, and I'm like, that's a 2,000% move in a week, if I'm correct.
What was the price at the time? I can't see a $70 contract here on that day.
Hold on.
It might not have been caught in this. It might have been
I bought it. It said Oxy $70 call for August 19th. On my Robinhood.
Oh, expiring on August 19th.
Yes, sir.
It's probably that 65 call and then the sell 65 call.
I just don't know, Brady. That's what I'm saying. Like I listen, it was cheap contract. I just wanted to get, if you guys follow this flow because.
So I think
Whether
okay,
it's just-
easier. I don't know how easy it's going to be to backtrack that, but basically it doesn't matter. But what Brandon is trying to say is, if you see a flow here, what you should do, and I didn't know that till he told me, right? I do this, right? I look at the visualizer of the trade, but this one I didn't even read this part ever, right? So what Brandon called out is this can
I
show
just did
you,
I just noticed it 3 days ago, Monetive.
yeah. So maybe it's a new feature then. Right. So for example, if you'd bought this, whatever, this short, right? This is a selling a 65 call. If you'd sold a 65 call here on 825, when the market opened, when it went to 58, you'd have sold it, you'd have made, 70% within, a week.
Right there, that right there is exactly why I like looking at this, right? Just because it says that it's down 37% right now, right? That's what the trade says that it would be performing. You can see basically, right? Like, oh wow, like this, I would have been up like 100% if this thing ran to.
Remember, you
65,
sold
right?
it here for 19 bucks. You could have bought it back here for 8 bucks. You're already up 50%. And you didn't risk anything. You just got a credit. Right? So by closing it at 8 bucks, you can keep 1,100 bucks of your premium. That's what you're trying to say, right? Brendan?
No, that's exactly correct, right? Like the other thing you can look at too is the purple line on the bottom is the IV, right?
Yep.
Your goal is you want to, when you're selling it, you want the IV to be as high as you can, right? Is that, or is that not the IV? What's
It was
the purple line
52
say?
when you sold it, let's say at the
Right.
low would have been 52, and then when you bought it back, it was a little bit less. Actually, no, sorry.
Right. Well, if you sold the IV, if you sold it at down there at 19, right? Like you had been selling 52 IV, right? That was, you received $18, right?
Yeah.
The trade. So then if you went up, right? If you watched as it went up, right? Over there, IV is 60. Oh, that's interesting.
Yeah.
Is it not, is 1530 minus 1530 is the options contract selling the call short?
No, wait.
That's interesting.
Yeah. This is a short, right? So
yeah,
it's strange.
What that means is you more than likely should not have sold it. And if you look, right, they tell off there, right? What it means is that at that time, right, it had moved up that much, therefore down that much. I mean, therefore you could have bought it back for $8, right?
Yeah.
But you'd be buying back more expensive IV than you had sold,
Correct.
right?
Look, it's a dumb luck trade. That's what it is. Because
exactly
that just a few hours ago or a couple of days ago, that contract was only worth $9 credit. And it came back to $9 credit right here. That's it. There was a short period where for some reason, the contract became worth twice as much.
I just want to
and
throw,
now if you look at
you guys can look at any contract, right? I know this is a little bit different, but this is when I'm talking about charting the premium, right?
Mhm.
It looks very similar to this. And I recommend, even if you're buying them naked, to look at the chart because it gives you a whole different perspective.
Yep. Okay, so I want to go back to what I was trying to do here, right? So swing trades, right? So first thing is, if you go out in time in terms of risk, then it is not just technicals that matter, right? It is not just flows that matter. It's not levels that matter. You need to know more, right? So depending on how far you go out, it might be macro, something happens, news, something is going to come, some policy change, or it might be fundamentals, right? If you go far out enough, which is why I'm saying when I start, I want to start with screening something that looks good in the first place, right? These are companies that make money to start with, that are making more money next quarter than they did this quarter, that did a little bit of a surprise on their earnings and this is just an example. You don't have to follow this, but the point I'm trying to make is important, which is eventually when we get back to a normal market in a year or whatever time it takes, right? Fundamentals become important. So you start scanning for stocks that are good in the first place, right? Not just something that moves randomly. So do a fundamental scan, right? Things like, okay, increasing earnings, low beta, high dividend, regular stuff that, people have been doing for 200 years. Within that, you can go into your technicals, right? Is it above its moving average? Is there a golden cross? What is the relative strength, right? So then you decide. So you scan for fundamentals, then you find the entry based on technicals, right? Technicals are always important for entry because anything that, even if your thesis is right, if you enter at the wrong time, you won't make money or you lose money. So the point to it is, look, you don't have to have this, right? Every broker has a stock scanner built in. Find good companies. If you, especially, this is only for longer term, right? Month, 3, 4, 5 month swings. So find ones that make sense in terms of fundamentals. Once you have that list, then use what you've already learned in the room and what you're learning, outside with your, whatever technicals that you use, whether it's moving average crossover or RSI or candle signals or whatever it is. Find in the chart what is working, right? Because you can, you can go scan a chart, right? You can go scan, you can take this list of 30, 40 companies that comes out of your scan and click through everyone's chart one by one by one. It'll take you, an hour in the, once a week. Do that, and then maybe 1 or 2 will pop out at you, right? So put that aside, finish the rest of your scan, and then come back and spend the time on it, right? Let's say, I don't know, let's take a company here. I don't know, let's take a random company. Zoom Info, right? Okay, so Zoom Info is a sales intelligence platform. So it's basically, they provide. Have you heard of LexisNexis? This is like that. It's a different, slightly different solution. What's the other one? How do you find out? About a company? This is basically finding intelligence about a company for your, for salespeople, marketing people. What is that? Anyway, well, I'm blanking out here. But anyway, it's a B2C, business to business and business to consumer play, but business to business. Sorry. So this company, if you look at, let's say, let's go to key stats, right? Okay. Year to date, right? It's pulled back 27%. How much is the market pulled back now? Maybe 15, 16%, right? So this is done worse than the market. But last 3 months, right? Growth companies have bottomed. Many growth companies have bottomed and started moving back again. Look at the last 3-month return. So this to me is interesting, right? 30% or 27% in 3 months. It's got no dividend, so not much to check there. Revenue estimates for current quarter, 280 million. revenue estimates for next quarter, almost 300 million, right? So that's a 6% growth in revenue. And, over the year, it's almost a 35% growth for next fiscal year in revenue, right? So it's growing revenue at 30%, 35% year over year. EPS, look at the EPS growth, right? 21 cents a share this year to 80 cents a share next year. Right?
So EG ratio is awesome. 10.36, that's really good.
Yeah, so you can look at all the valuation here, right? So a lot of people have different tools, right? Based on the kind of money you're willing to spend. For me, this is cheap enough, but I'm not using it. So anyway, that doesn't matter. But you look at enterprise value is close enough to market cap, and we can go into that later. But P is ridiculous right now. Look at that 180p. Do I want buy a 180p company? Why did it go up 27% if it's 180p right now? Maybe the answer is there is growth. And look at the forward PE, right? We saw that next year PE full year is going to be $4 from 80 cents. Your multiples start coming down naturally for the right reasons, right? Your PE goes down from 80 to 180 to 60, right? And go forward even longer, it's 45. Now it starts getting more interesting. Still expensive, but they still have growth. So that's why it gets interesting, right? So, and depending on growth companies, other, these other ratios might be more valuable. And this is not the time to talk about that. We'll bring I'll try to bring somebody who's really good at SaaS companies to talk about how to value SaaS companies. So I'll bring him to our session, and he can explain what to look for in SaaS companies. But anyway, these are high beta companies. See, there's just nothing. They have some debt. It's not bad. Debt to equity is not bad. I don't follow these ratios, but it's worth learning what they are. Revenue per employee, it's a useful metric, not very valuable unless you are deep into tech and understand how much they generate per employee, because employees are expensive in tech, so you have to generate a lot more money per employee in tech versus outside, right? So this number is always high. It could be as high as $1 million plus in some companies. So anyway, so you look at all that, you say, okay, you know what, this company has solid financials. You can compare. Let's assume for a minute that the comparative companies are correct here, right? So this is Team, PagerDuty, Monday.com, Bill.com, and ZoomInfo. Okay, so you can compare this. In one page, you can see, what is the, let's go down to the ratios. Where is it? There, right? So you can look at, many of them are not making money. So, so ZoomInfo has recently started making money. That's why its P is so high. They probably just started making money, either this year or last year. And it starts coming down, right? But sales, right?
Monetive. That like one of the most important metrics, like that you were just discussing, the growth, right, of and how the PE forward is 61 and then in forward 1 year is 46. That metric, PEG ratio, is what most SaaS people, like like investors, will use as understanding how, right, like how much is the profit earnings growth, right, growing, because then you can pretty much understand how soon will I be at a ratio of 30, 20. Right. And then how soon does that return me my money back? Correct. Look, price and earnings, right? There's only two ways that this multiple can go down from 180 to 40. Either the price goes down or the earning goes up. So you have to do it the right way, right? If the stock crashes in price, this number will come down automatically. You don't want that. You want the earnings to go up. Those others may look less like, shitcoey, right? Like when you see in
Correct.
terms of just in terms of PE ratio, but then if you look at the PEG growth, right? They're
Yep.
not growing their earnings, right?
Right.
They're negative, and the other two don't even have earnings. Right.
Correct.
So in
Not
this,
yet, right? Yeah.
that's what stands out to me is the 10.36 blows
Correct.
any of the others out of the water when you're talking about earnings.
Yeah. So that's why Zoom Info is actually a pretty good company. I know a few people that work there. But yeah, so you have to do this analysis if you're starting to invest your money for a period, right? Any period of time, let's say more than a few months, you need to know a little bit more than just the charts. So look at this, right? Look at the margins. Look at all of these companies, right? Over 80% gross profit margin. So these companies, right? Obviously they develop something, after that it's all pure profit. So you wouldn't find this in industrials or materials or any of those, right? This is where, and the other point, right? So Zoom Info has turned the corner already. You can see that from, let's say, comparing it to somebody that's losing money on their capital versus starting to make money. And this number, when that PE goes down to 46, this number is going to be easily in the mid-teens or high teens.
Yeah, there was that number too, the EBITDA to the EBITDA margin.
EV to EBITDA, yeah.
Yeah, EV to EBITDA, right? They're negative 27 right now, right? If you went up a little bit, it was the EV to EBITDA margin, right? So like their earnings before interest and tax, like so they're making it 81% profit, right? But it shows you their expenses are so massive that their EBIT margins are actually negative, and then Zoom Info positive 16.5%, right? So that means that their earnings are that way because if you went, it's just a little bit down, tad down, and then it's right, there's a tad more down. I think yeah, just a little bit more down. There's an EBITDA margin line, and they're all negative except Zoom Info's positive. They're positive 16, right? Those companies, they may make a profit on their product, right? But up one.
That's here, right?
In between. No. The EBIT margin. On that list. Yeah. So like their margin.
Have a lag on the Zoom. Yeah.
Yeah, it was 16, right?
Yep.
The comparatively, look on the right, minus 19, minus 838, they're all negative, right? That means that their product, right? How much the goods make, like it costs to make that product, it's minimal in SaaS companies, right? The tech is just monthly recurring revenue on a one-time build, but their costs, right, are costing them 42%, right? More. These guys are their margins are so heavy. Zoom Info, their earnings was different and their earnings showed growth because of the fact that their EBIT margin is positive.
Yep. Yep. So okay. So you've done your analysis. Let's assume that we like Zoom Info, right? Okay. We know a little bit about Zoom Info. Let's go to, actually, that's not it. We don't need that. Let's go to technicals directly, right? Okay, the chart looks like this. This is what? How many months is this? Okay, this is a year now. Okay, so they bottom somewhere in the low 30s, and they're up. You saw that, right? 27% in the last 3 months. This is this run. Okay. So there's a gap here, right? That has not been filled yet, potentially. So if you want to play this stock, there's another gap here, right? Right now it's $47. So let's take a look at this. Come up. Okay. So Zoom Info, actually, let's do it the way you like, Brandon. This is new for me, so I will follow how you think about this too, because this is very interesting. Let's look at what flow has been there in Zoom Info. Let's say I want to see the last 2 weeks. Nothing. Really?
I go to historical for the past 2 weeks. Yeah.
I did that. It's not much in terms of this big. All right, they're mostly negative. So there's a straddle for November 18th. I'm guessing that is earnings play. What is the earnings date for this?
Notice that they're all like most of those are doing the straddle, right? That same
Yeah.
day. That remember how we discussed the other day in the I think it might have been the space that the weekly move, right, is determined by the weekly straddle, right? The expected move. The expected earnings move is done by the weekly earnings straddle. So playing
this
that
is
straddle
around
in advance
earnings,
is
right?
great.
This is November 2nd. I think this probably will only have monthlies, right? It's a new enough company. So yeah, so they don't even have, wait, that doesn't make sense.
It's the first expiration after earnings.
Yeah, but I don't see a November here. Oh yeah, here, sorry. Yeah, it's the first expiration after earnings. So this is an earnings play basically. All right, so somebody is,
Look at that range that it breaks even at 36 to 53.
yeah. So somebody here is betting that, you know, what am I seeing here? Somebody here is betting that, you know, it's going to stay within that wide range, right? Between 36, it's going to either go below 36 or it's going to go above 53, right? Did I read that correctly?
Opposite. It's at 48.61. They believe that it's gonna if it drops, it's gonna drop to 36 being the lowest, and if it goes up, it's gonna go up to 53 being the highest.
Okay, and this is a credit. So what have they done? They've sold. They've sold two calls. So they've sold a put and they've sold a call. So they collected a premium of $830. Their max
Expected
loss
earnings
is
move is gonna be assessed as somewhere between as the spread of
between
36 to
36 and
53.
59.
Yep.
So basically between 37 and 53, they'll keep their premium. If it goes any worse, they lose money. Right?
Yeah, they're basically saying most of this priced in, right? They'd like to basically bet that most is priced in, and if anything, it has more room to the upside than it does the downside.
Correct. So I didn't explain that very well. I should have let Brian explain that. Brendan explain.
No, Monetive, you're doing amazing.
I'm gonna tell y'all, this is an amazing class. This is a great class. This is stuff I did when I first started trading. I did like my research and my due diligence, and because I was playing commons. But now that I do options, I don't even play commons anymore. Like I have my long-term stocks that I haven't even touched in like 4 months. So this,
I'll tell you something then. Okay.
This is perfect.
So I'll tell you how I invest my fund, right? So I have a family office fund. That's my family money that I invest. So let's take this example, right? So let's say I've done my research. The stock has, bottomed somewhere here, okay? Or let's take a better example, right? Let's say that I did my research back in early summer and I was pretty sure that this was a good buy already. It had come down from what, 105 to $30, $35, okay? So let's say I was interested in the stock here back in May, $30, right? Now, I don't know what's happening in the market because it's not happened yet. I want to start a position here, right? So I have one of two options, right? I can either I don't want to do it as a swing trade, but I want it as an investment, right? I'm just going off a little bit differently here, okay? So bear with me. So how I typically do is when I start and I'm unsure of the direction, let's say we don't have like a, you know, a COVID event where, you know, the Fed said they're going to do whatever it takes to fix the market. If that's the case, there's no downside because the Fed has got that covered. You could just buy the stock or you could buy leaps and you're good. But now that's not the situation. We know that there is going to be a downside, right? It's not happened yet, so I don't know that it could go as low as 29 from 35. So what I do is I buy some stock here. Let's say 5% of my position I buy when I know. So if you look at this, right, it came to 34, it went up and then retested it once and retested it again, right? So let's say we're not there yet. Let's say it went up, then came back down, retested it, started going back up. So somewhere in the 36, 37 range is when I would have bought a small position, okay? Then it started going down. Now then it broke the previous low. I would not have bought here because it went back to the previous low. Now I want to see what happens the next day. Since it went down further, I would not have bought here. As it went to, you know, its all-time low here, right? This would have been an all-time low for the stock. Then I have one of two options. Either I take another risk without knowing anything. That's a hit or miss. I don't know what's going to happen. Right? It could keep going down. Right? There is no signal here, right? There's no support line here because this is all-time low. The resistance is where it failed, right? This is 35 is your resistance. There is no support. So there's no reason for me to buy. So I still have my original position around 37. I've lost, 20% in this stock. I have only a small position. I'm okay. So what I typically do is I wait for it to test that position again. It failed, but it didn't come back to the low. So this is where I would have bought my second lot. Okay. So let's say I buy another 5% here. Now it keeps going on up and down, and let's say we are here. Okay. I bought, let's say 30% of my position. Now I read all of my analysis again and I figure out, hey, this is a bounce point. It is retested the low. It didn't break, right? This is the same low as before. All-time low was retested. It didn't break. Said, okay, you know what? I'm going to try to, I'm pretty comfortable. This is a good place. So what I would have done here is I have all my stock. Right, I have, let's say, a 30% position of what I'm willing to put into this stock, and I'm at a loss. So right here, I would probably start buying some leaps. Okay, I'm just explaining what I do. I'm not saying it is right. I'm just telling you guys what I do for my long book. So I would start buying leaps here, right? Let's say it goes down further, I'll take the loss in the leaps. And if the thesis changes, if they miss earnings, I will get out of the stock, take my loss. But if they beat earnings and the stock is still going down, I will add my position, meaning fundamentally the stock is good, market is getting beaten up, the stock is going down, right? So I might just hold on. I might start selling some covered calls, or I might sell puts right below. Okay. But typically what I do is when I find a solid place, I start buying leaps. Okay. Now, if my thesis is correct and the stock comes back to its cost, right, my original cost of 37, my leaps would have made a killing. So I will take that out. Right, that profit from the leaps I will get out, And that way my cost of my stock is going to be below, right? Let's say I averaged it to 34, but I made another, $2-3 from the leap per share. So my cost is now closer to the bottom, right? $30, right? Or $32, let's say. That's okay. I can live with that. So I start building a position again, right? So that's what I do. I chase it down a little bit to find a support, and then I chase it up with leaps. At that point, chasing the stock when it's climbing fast with commons, to me, is not worth it necessarily, because you're going to pay a lot of money and your cost is just going to go up. Instead, if you buy leaps till you get to your average price, you can either let the leaps run and sell your stock, or you can sell your leaps and you keep your stock as your position and your cost average is way down. That is how I build my position in most stocks.
Hey, Monetive.
Yeah.
One thing that one thing that I would have done differently on that, I don't know if that's what you did, but that's not the all-time low, right? Like, we've been down here before. So if you go back,
It's a new company, man.
Zillow?
No, this is not Zillow, but you're right. No, I'm just giving you an example. I don't have any growth company at all, right? I have zero. So I don't typically buy these kind of companies, right? Because I don't know what the low is. This is not Zillow, this is Zoom Info, but you're right. If I look at 5 years, the all-time low is 11.
No, it is Zillow, but I know.
No, that's why, right? I was looking at the wrong stock then.
No, I know it never changed, and
no,
but I get what you're saying though, man.
Right? No, the one we were looking at is Zoom Info.
For the
This is the fundamentals we looked at. Sorry. Anyway, I was just trying to make a point, but
what you were getting at is you would wait for a retest of the low, and then you'd be averaging.
So look at this is all time, okay, for this stock. This has only been traded for 5 years, okay, not even 5 years. When is it? September 20. This came public in the summer of 2020, okay. So the all-time low in this stock was right there. That's why I said this one, right? $27 was roughly the all-time low, something like that. 26, 27, whatever, right?
Yeah.
So this one is a solid support. It's already run up, but good catch. You get my point though. What I was trying to say is, I would have probably looked at it here, right? This has been tested. It fell to 42 in March. It ran up, retested that, broke, but climbed back, right? And for few months or almost a year, it was above this price, tested it again, ran up, right? And finally in June, it broke down, right? So if I was looking at this in June, I wouldn't have expected it to break down, right? Let's say I didn't know the market. We are in June. It's not happened yet, right? This has not happened yet. I wouldn't know that story. But all I know is it has tested that 1, 2, 3, 4 times. And while it broke it once, it always bounced hard from that level, right? So that's what I'm saying. So the point I was trying to make, not very well, was I typically, for my very long positions, right? This is at least a year or longer, right? Typically my positions are 5 quarters, because I try to adjust the time when I take profits. So I would have started a position here, very small size, maybe a couple of 100 shares. By the time I went through this cycle, I would have probably built a 30-40% position if I didn't know how the market was going to stay. If I was very confident, let's say the Fed gets on the sideline, I will build a bigger position. But since I don't know that, I'll probably stick to a 20-30% max position size. Look, when you build a long book, right, you can't keep selling out. It's you just have to hedge your loss somewhere else, right? So typically
What you said about, I mean, so that's what I was talking on the wrong microphone, but I'm writing down what you said. So I mean, you did it really well. I mean, who cares what chart we were looking at? But the thing is, what you said about not chasing your price with the commons, right? Because it's going to raise your cost basis, but instead chase it with leaps.
Correct.
Which I want to just make sure everybody caught that, because it's
Yeah.
Yeah.
I mean, think about this for a second, right?
What's your thought process behind the leaps? You're using less capital and still averaging down. Is that the thought process?
Yes and no, right? So here's the deal, right? If you're doing a long, if you're going to hold for a year or longer, right? You're holding it for capital gains, right?
Yeah.
That's the thesis, basically. You want to save on taxes and you want to let it run. Now, in a typical stock, let's say this is a nice growth stock and it could double, right? Let's say the price goes from 30 to 50 in a year, right? That is 60%, after tax, it's about 45%. Great return, okay? But let's say the same thing, that you invest 60% of the money you would have put into the stock into commons, and let's say 10% of the money you would have put in commons, instead you buy leaps and you leave it as a half position, right? You let's say your position for a full position, let's say, is 100K, just for simplicity, right? You buy 1,000 shares and you stop. Your average cost is 35. So you are at 35% of your max position. And let's say for about 10,000, you buy leaps, right? That those leaps will probably generate another 20,000 in profits for you if it goes to 60, right? If you buy leaps from your support, right? Your long-term support, this whatever, what is this number? It's about
30 bucks.
Let's say it's $30. That $30 is long-term support. It's been tested September 20th, and it's been tested now in June 22nd, right? And it's held. So let's say you start buying leaps after it broke through, it recovered, then it retested, and then it recovered, retested here, right? So let's say you buy it even here, $33, $34 something. Let's say you buy a $35 or $40 leap when it's here, it might cost you $6-7, okay? Or $10. Let's say it even costs you $10. When it goes to $50 this time, your leaps are worth, I don't know, $25 maybe. That 25 is already 2.5 times, right? So even if you pay long-term gains on it, you're going to make a double on your money. But your stock, you're not going to make that money. First, it's a larger gain. So you don't want to necessarily, it's a larger investment. You don't want to necessarily scale it up that much, right? Because your risk also goes up. So by keeping your stock investment down, you add alpha to your overall portfolio by adding a little bit of leaps when you know there is a tradable bottom. But that tradable bottom, I found the hard way by losing money, right? That's why I want to recover it back quickly.
Thanks, Monetive. That's really great. I have 2 such stocks, or maybe more, SoFi and Open. I bought them at the height.
They are not necessarily the best, examples to do
Right.
this. One, they've gone too low already, right? You look in those when we saw the comparison, right? Among these are all, where the heck are they? I need to go back. This thing sometimes misbehaves. So when you look at these companies, one thing is very clear. Even in this market, they're growing at 20, 30, 40+%, and they're beating every quarter, right? ZoomInfo, Bill.com, Monday.com, PagerDuty, and Atlassian. Team is Atlassian. If you're investing in SaaS, you'll know these companies. They are all serious growth stocks, right? Super performers. But even in that list of super performers, we saw that, you know, only this company actually makes, you know, an actual positive margin, right? EBIT margin. So even within this group, this might be the one of the 5 that you want to do the strategy like that on. You don't necessarily want to do it where companies have not. Look, these guys might continue to lose money. They might continue to keep going down. Let's say their growth slows, right? They don't have a profit yet. Their growth is starting to disappear. This could go to 0. I'm just, you know, exaggerating, but I'm trying to make a point. Right. So you want this ZoomInfo has crossed over to being a profitable company. Now there is a downside protection because they not only have growth, they're making money, right? So it's not going to 0. It might go down from 20 to maybe 10, possibly. But for it to go to 10, there has to be something very wrong with the story. If you don't see it today, then you can take a risk. If there's something wrong with the story, then you will see it in the numbers.
Monetive, let me ask you a question.
Yeah, of course.
If you had if you had 100 shares, right? If you're maybe trying to make money off your shares, if you had 100 shares, would you sell puts on the way up and sell calls on the way down? Just for the options flow.
So okay. So I didn't want it to get complicated, but let's think about that, right?
I was just curious.
No. It's a great question. So it's a great question, right? Okay. So typically, let's say this is max, right? So let's say this was my initial entry, okay? Because I thought this was support. I was wrong. Okay. So
yep,
I have 2 options, right? I have 2 options. My first position was at $42, right? Because I know it was tested 1, 2, 3, 4 times. I bought it here when it came back to 42. It didn't hold. It fell right back, right? So I can buy more shares when it, let's say, when it fell back and climbed here, okay? So let's say I can, this is a gap. You see this?
Yeah, I got you, brother.
After that gap fills, I can say, you know what, this let's say it's $38. I could either buy here, or what I could do is, hey, this just gap filled. I don't want to buy here, but I want to sell a put at this price. Okay. So I sold put. Now what happens 2 weeks later? I get I have to buy that stock at that price, right? It's going to be put to me. Does that make sense?
Yes, sir.
So instead of buying a stock at this price, I'm buying a stock at this price, right? So that's a better option in this case. It would have just worked that way. So I can continue to do that, right? Instead of buying. So when it comes here, right? Let's say we gapped up here again, right? We fell back, we gapped up here again. So I'm thinking that is support. I sell a put somewhere, let's say 32.50. It might have gotten put to me here again when it briefly broke the low, right?
Right. So you follow the trend. You follow the trend when you buy.
Correct. So I can either, instead of buying additional shares, let's say I can sell puts a few bucks below that, right? A few, let's say 10% below where the current price is. I can keep selling puts and it'll get put to me. So instead of buying now, I'm just postponing that buy decision to a lower price. Or I can just buy stock. Now on the way up, right? I don't want, this is a violent move. If I sell covered calls, it's going to get taken from me, right? So I need to find support. Okay, we are back to this 42.5 level. We know that's very well supported. And we know that recently it has been unable to break this, whatever, 51, 52 level, right? So when we are here, I might sell, monthly covered call up to here. But until we get to some point, I wouldn't sell covered call. This is too violent a stock that it'll just get taken from me. But in this case, I'd have probably on the way down sold puts instead of buying additional stock.
Right, right. I got you.
Now, typically what I do is okay, let's go back to, let's go back to that comparison, right? I'm going to just make some assumptions here. Okay. So the way I manage my portfolio is, let's say let's say these are all comparable companies in the same industry. Okay. They're not exactly the same. In fact, they're far away, but let's just, for simplicity, assume that they're all very comparable companies. Okay. Zoom Info is the strongest and PagerDuty is the weakest. Okay. I'm just assuming a few things here. Okay. What I might do is, I know that I'm buying the leader. That's because that is what I want to hold on to. Now I could take away some risk by shorting the weakest company. So I might just, go short PagerDuty here. And if I look at my SaaS portfolio, it is, a long short portfolio, right? Within that portfolio, I'm long the leader and I'm short the weakest stock. So I might hedge that way, or I might just say, you know what, I don't know enough about PagerDuty going down. I'll go find a SaaS ETF and I will short that SaaS ETF as a hedge. But I'll do that only if I have a full position. So let's say my full position is $1 million, right? Then I don't want to be exposed and I don't want to keep selling Zoom Info. I want to keep it forever. Then what I would do is I would keep my Zoom Info position, maybe sell covered calls on it if it's stable. And then I would go find an ETF for the whole industry and short the ETF on a regular basis to as a hedge. So it's basically, it's a standard long shot, but you do it depending on what you want, what your conviction is, right? Most people either take a basket of longs. Let's say they find the top 3 strongest companies in an industry and they go long, and they'll find the weakest 3 and go short. So you're basically, you're neutralizing your risk within the sector. These
This
are
is
all
genius. It really is genius.
No, it's
Yeah,
not.
it's a lot of thought.
Dead
It's a lot
common.
of thought put to it. You gotta put thought to it. I like it.
So you have to remember, guys, right? So when you're managing, let's say, sub $1 million, things that you do that will work with that money won't work when you have 10 million. It certainly won't work when you have 25 million. You can't do the same thing anymore. Then you have to change things. You have to be long some stocks. You have to have a percentage of money in the market, whether it's going down or not. You don't have a choice. If you sit in cash, you're just going to get burnt with inflation, right? And most times you don't have that luxury. If it's your own money, it might be okay. But when you're managing money, you cannot be in cash because you're collecting a fee from somebody, right? So you have to invest it. If you invest it, how do you de-risk? You do a long shot, right? You go long what you think is good and you go short everything else.
Monetive or Brandon, let me ask you guys a question. What's the riskiest swing or straddle you can do? Is it that what's the riskiest swing you can do, and the non-riskiest?
The riskiest thing you can do is buy a high growth company without any hedge.
I would say with the options, like when you do the iron condor.
I'm not the right person. Brandon is probably so my options, right, are either hedges or they are swing spreads, right? I don't take anything more than that. But the riskiest I'll go is have that short leg, right? So we saw that before, right? What I was saying, a call spread with a sold put, that's the riskiest I will go. That's a big risk. If you don't manage the put, you could be screwed, right? Because your loss is infinite. The stock, you could be the entire price of that entire strike of that put could be, could be on you, and you could lose that, right? If it's a 150
Right.
strike that we saw in MDV, you could lose all $150, right? That's 15,000. That to me is the riskiest.
Well, I'm just saying, when you guys do these kind of trades, I'm just like, what's the more riskiest and more valuable one? Because I see a couple of them. I'm new, but I'm not new, so I understand the iron condor, but like the naked calls and a lot of these
So
spreads
this,
is like it's a lot to understand that I don't know.
so this trade, right? I had this trade. These are my saved trades. Many of them have closed. I have to go and update it, right? This trade from the time I took it was up 60,000%. Why is it 60,000%? I didn't make 60,000 K on it, right? I got a credit of a few dollars, and now I sold it for a credit of $3,000 per contract. So this
You're talking about
number,
the ENPH, right?
yeah, that's the short, right? So basically
Right.
what I did was, when the price was $325 at the high, I sold I bought a put spread, right? I bought a 310 put, sold a 260 put. Okay, so this is a short, this is a long, right? So I bought a 310 put, I sold a 260 put, but I didn't want to pay I didn't want to pay the delta in the trade, so I sold a 370 call. Okay, so that is so there's a short 370 call, a short 260 put, and that was a net credit of like 90 cents or something like that. So I not only got paid $90 to do the trade, I sold it for $3,000. So
Yeah,
that
that's
is the
crazy.
riskiest trade I've done this quarter.
Yeah, but if you add them all up, that's your profit one. So, like I said, I'm new to this. This is all amazing.
I had 30, 40 contracts in this, so it's big money. But I have 10 contracts in this. I think I'm losing what, $5,000 or something. I adjusted this trade, but I'm losing $5,000 in this. That's because I didn't pay attention that one day it pulled back dramatically, and I lost my shirt on this. But as long as Boeing closes above 125 in December, I'm not going to lose anything. It has to close above 124.20 or something like that. I collected $80, so it has to close above 124.20. If it closes there, then I'll recover my current losses, right? It looks red because it's close to this, right? It's close to my sold put, so it looks horrible. My call is worth so I'm losing money on 2 contracts and making money on 1 contract right now, but it'll all even out and I will make it up. So that's why I'm not closing this. That was just dumb of me. I didn't manage it. But yeah, this trade, right? I'm technically losing a shit ton.
No, man, so if you're learning, brother, I think that's the whole process of this stock market. Like I said, I'm kind of new into it, but like to see this and brother, it's not a loss, it's a lesson. And you're good. I like it. Like your
So
head on your shoulders.
I'm with you guys every day, right? We can look at
Yeah.
any trade in any detail you want, right?
Well,
I'm
listen,
there.
if you do any trades like this, if you can post them in the market chat
I
or whatever.
actually want to do a trade. So let's actually look at that.
Okay.
So First Solar, right?
I was
First
just going to ask you that, Monetive.
Yeah, that is where this discussion started. So let's go back.
Thank you.
Sorry, I tend to talk when I'm not bothered by people and interrupted. So you have to interrupt me to shut me up. Really, I'm not kidding. So you need to interrupt.
I'm here for you.
Sounds good, brother. Yeah, you sound
Okay,
good.
we looked at
FSLR.
Okay, we looked at FSLR, right? So this chart, right? This I definitely want to short. Look at this, right? All-time high. Okay, it's close enough to we're looking at the right one, right? Okay. is it? Why am I looking at this? No, I don't want to look at this. Go to tech chart. Okay. All right, 145 is the all-time high for this. I know a little bit, so we don't have to go back and see, but we are right now at about 80 P. Okay, the forward P is over 55, 60. In this market, that's ridiculously high. This was earnings, gap up. Okay, 75 to 86. All of this run was in expectation of the Inflation Reduction Act. Okay, so we went from post-COVID high, this is 121, all the way to 56. We retested that 56 a few times. So let's, whatever, $60, let's say. We retested that $60 multiple times. So let's say that's a solid bottom for this stock. Okay, come earnings, they beat by a lot. Went from 75 to 86, so 15%, not a big deal. It just kept going and going and going. The Inflation Reduction Act is somewhere here, just kept going. We've had what? Serious drawdowns. Remember all those days where we had 1,000-point drawdowns? Nothing. It went from 135 to 125. That's it. And now it's run up again, right? 145. Okay. Now I'm saying enough is enough. In the same, let's add, can I add a security here? Okay. Nope, it didn't do that. How do I do that? Where did it switch? Let's go back. How do I add a second? Oh, it didn't let me add. That's strange.
Is that your blue line?
Which
Back
one?
on that chart? Is that the blue line?
Did it add?
I think it added as a blue line, but I'm not positive, but yeah, so if you add it again, I think you had a blue line pop. There it is. Is that the blue line or is that the
No, no,
orange?
that's your moving.
Oh, those are the
average,
SMAs.
okay?
All right. Nice check.
Yeah, it didn't add. Go. Okay, it's just Google. You can do it easily. Wait, where's the bigger chart here? Oh man, I'm struggling so much today. I think it's just late. Okay. First solar and face. Let's look at 6 months.
Yeah,
Okay.
maybe just blow it up, like, or zoom in.
How
That's
do I do
easier.
that?
Just on the web page, maybe.
Yeah, I can do that.
Yeah, no, I'm not familiar, unfortunately, with that. I don't see a button that would
Don't need that much. Okay.
perfect.
So which is which? Okay, the blue one is First Solar. Okay, so we're roughly $3 below all time. Where are we? Yeah, we are $10 below all time high. So let's call it 8% pullback versus Enphase went to 220 to 325. What is the current price? 261. So we're down 20% in Enphase, 20% in Enphase. Okay, so 8% versus 20% drawdown. Okay, so I think this is coming down. Okay, so anyway, so let's go back to this. Right, so First Solar. So I am bearish. Okay, so we'll switch sides. I want to do a put spread. Okay, This is typically what I do on a short, okay? So I want to do a put spread. So the current price is 130, right? I'm not going to waste my money on this. So I'm going to buy a 125 put. And I'm going to sell, I don't know, let's just pick something. Okay, so that's roughly 2-to-1. Okay, if I go out in December, so profit of $1,000, loss of $500, which is the cost of my contract. Okay, so with me so far?
Yeah.
Okay.
Yeah.
Profitability is 36, right? Okay. Now I know this is already overpriced, right? We are at 135, 132, sorry. We are at 132 today. I think this has a long way down. Okay. So I'm going to go a bit aggressive. I'm going to sell a call. Okay. But I want to sell a call much further away, right? Let's say 155 call. Okay. So if I sell a 155 call, buy a 125 put and sell a 110 put, which is this, right? I'm selling a 110 put, which is the far out put, right? Short put, long put, and short call. I make a net credit of $75. So 75 cents per share. For 100 shares, that's $75 credit. Okay, now the probability of my profit has gone up to 75%, right? It's more than doubled. Of course, the loss is infinite because it's a short call. There is no limit. The share could go to 1,000. I have to sell it to somebody at 155, right? That's dumb. This risk is much higher than on the long side. So this is where your entire headache is going to be, and this is where your entire work is got to be done. Okay, so one of two things happens, right? So either the stock goes up or the stock goes down. If the stock goes down, remember your loss is infinite because of this short call. You want to get out immediately. So if the stock is moving down, you take this out. So you sold this for $6, $5.75. If the price moves to, let's say, 120, this will probably be worth only about $3. So you take your $2.75. You've already collected a credit of 75 cents. So you made $300, $350 on this already. Then you let the other two go and close them together. Or you have the margin, the market is, let's say, Fed is crashing the market, then you don't have to deal with this because it's unlikely that this stock alone is going to stay up. It has, though, unfortunately. But the assumption is that the whole market, let's say, finds a new bottom, this thing will go down. If it keeps going down every day, then you just wait and find a place where you take the entire trade out, right? So for example, let's say, where are we? Let's say at, this is December expiration, right? So let's say, when is the Fed meeting? November, no, end of the month, right? And when is the election? November 4th, something like that, right? November 5th, okay. So we are somewhere here. The Fed has increased their interest rate one more time, and the market is, and we are near the election. Let's say after the election, the market is crashing, right? If the price is what is our strike, right? If the price is below 120, you collected a $75 credit first, and now the contract value is another 400 and is $400, right? So you made $400 from that contract. The percentage calculation, don't worry about that here, right? But effectively, you not only got a credit initially, you got another credit of whatever, $325 here. So you made a total profit of $400. As soon as you take this out, you can let the rest run, and you can make a profit. So you probably make $200 just from this and $75 from this. Then you let the rest run, and you are maxed. You can collect another 150, or what is it now? $15, right? Yeah. So the max you will make after you take this out is $15, right? You see that this is the difference between the two strikes. So you can let it run. You can close it and take your money if it's less than that, or you can wait for it to get to max money. If the market is flying down, you can wait for it and take it. But this is a trade I might take tomorrow. But I wouldn't take that. I would probably go a little bit. I don't know. There's no money
Well,
here.
Mons, if you make this trade, just keep me posted, brother. I would like to watch it. I like to, watch what you're doing. Pay attention to what
Yeah.
you're doing.
I can actually. I'll share my brokerage where we can, take this trade.
Yeah, I'd like to
play with it a little bit.
action too.
Yeah. I mean, I can bring this in, but the risk is, it might hit that price, right? So we know that this is already.
This is not financial advice. That's what you're saying. This is not financial advice. This is education.
Of course not, right? Of course. Look,
Yes,
I
sir.
do
Yes,
not
sir.
sell a service. I do not manage other people's money. I manage only my family money for now. Down the future, I might go back to managing a fund, but no plans yet, and no active work on that. So and I'm not licensed right now. I had my licenses years ago. I've given it up. So I'm not allowed to sell any. I'm not allowed to advise. I'm not allowed to sell anything. I'm certainly not allowed to raise money. So
No, but I just want to wait. I just want to watch the trade. I want to see if it works. Because if it works, I'll come back to this video and probably watch like 6-7 times.
yeah. So
I appreciate it.
so
I appreciate the information.
So Enphase trade was like this. It was bleeding for a long time because, I started selling it when it was 320, 310. It kept going. It went all the way to 325. But thankfully, at least my call was out to 370, 360. So I didn't get a call, but and I didn't have a margin problem because it was far enough away. But it was on the 30 contracts I had, I think at one time I was losing 25-30K, but I probably made 100K from that trade overall. But
Nice, brother. Nice.
but again, right, that's in my main account, right? My trading account, I do 5,000 max, right, per trade. In my investment account, I have so the way my investment account works, typically I have about 50% long positions, 30% cash, and 20% swing. So that 20% of my investment account is pretty big, so I can take big swings. But I cannot do that in my trading account. My trading account is only a couple of 100K, so I don't take more than 5-10K per trade. Right.
Well, listen, if you make this trade tomorrow, I would love to see this play out, man.
This one I'm going to test, right? I'll probably take a couple of contracts, right? Depending on how we open tomorrow. If we open up, I will take it. If we open down, I will wait because I know that the stock is very strong. It'll probably try to come back to that 135, 140 level. So I'll probably take it there. So if it opens up tomorrow, we'll take the trade. If it opens down, I will wait.
Got you, brother. I'm gonna keep an eye on it.
So Monetive, if I were to say this trade in a sentence, how would I start? I'm just trying to. I see the visual.
It's a put spread.
Mm-hmm.
It's a put spread financed with a short call.
Okay.
Yeah, and I think what going back to like what Brendan was saying, and we were saying about saying it in a sentence, right?
Right.
What you're saying here, you would say it for each contract, basically, right?
Yep.
So like for the put, the 110 put that you'd sell, right? You're selling, or you're basically well, I don't know how do you say that exactly? I don't want to mess it up, but
it says I'm betting that the stock price will be at like that. Yeah.
Yeah, and that I am willing to buy.
Oh, you want to say it that way? Okay.
That's what she's talking about. So
I see what you're saying. So I am betting that the stock price goes below 125 but will stay likely above 110. I don't want to pay for that contract, so I'm selling a 160 call for a credit on the overall trade.
Okay.
Yep.
Thank you so much.
So
Yeah.
let's look at that, right? Okay, actually, let's pull that back to 155. Okay, so you see this credit, right? $75 credit. If I take this away, now it's $500. I have to pay $500, right? So I don't want to pay for this yet.
Mm.
That's why I'm selling, I'm shorting the call.
Yeah.
So actually, this is interesting, right? So let's look at this, right? I'm still bearish on this, right? Let's look at another option. So this is a butterfly, okay? A broker, so a butterfly is even, so what it is a call butterfly is you buy two calls and you sell, you buy two strikes, okay? One far away, one, so one above current price, one below current price. And then to pay for it, you sell two strikes, you sell two calls in the middle. So you're short in the middle and long on the ends, okay? That's a butterfly, okay? What a broken wing butterfly is, that short is not in the center. So you're biased to one side. This case, you're biased on the shorter side. So you are, in this trade, you are buying a 135 call, you're buying an 85 call, and you're selling 297.5 calls. The difference with this is, remember, right, your risk reward is still better than 2-to-1. Profitability is not great, but this is your max loss. That's it. There is no margin in this because it's evenly balanced trade. You have both a short and a long even. So you don't have any margin exposure, right? So you can take this trade with a couple of $1,000. You get in this case, right? You get a credit of $1,400. And there's a 40% chance that you can keep all the credit and double your money if it goes your way, right? So the break even is below 123. So that means the current price is 132. If the stock goes below 123 in December, when this expires, you make $2,630. That is, you keep your credit and you make another $1,000 off, $1,250 from it. So this is a safer trade, but it's lesser probability. So this is called a broken wing butterfly because the wings are not equal, right? So if I try to change it to the middle, see, it became a long call butterfly. Did you see that?
Mhm.
Right.
But back here, 97, it's called a broken wing butterfly.
Yeah, and keep in mind that chance of profit is always based on the expiration date, right?
Correct.
So it doesn't, that does change as you, as if you close, you have the option sometimes to close it out early if it goes into profit, right? So
Actually, this is a better trade. I don't know why they suggested that. This is still better than 2-to-1. Smaller credit, slightly higher probability, right?
Yeah.
But the break even is also better. Actually, break even is higher, right? 6. So if it loses $6 more, which I fully expect it to lose, you make a killing on this trade. You don't pick up much up front. The only difference is that trade you get paid most of your profit right up front, versus this trade you have to wait till expiry to collect the ones.
That would be the difference, right? Yeah. You in this sense, or in this situation, you want to wait for
butterfly. Tomorrow, somebody remind me tomorrow. I will post. My friend Archana is the person who can teach butterfly, and she's done some YouTube videos already on what a butterfly is and how to do it. So I will send you a link to that.
Definitely, yeah.
She's
What's her name? What's her name, Monetive?
Sounds good.
Her name is Archana. She actually changed her handle because somebody one of our friends started calling her Butterfly Queen. So she changed her handle to Butterfly Queen Archana.
You said on YouTube? She got YouTube videos.
Yeah. She has a YouTube channel. She does she also does write on Substack. She has a service too, but she does post free YouTubes, and she posts trades every day on Twitter too. So I'll send all those links. Just somebody remind me tomorrow. I'll do all that.
Cool.
Yeah,
Hey,
I'll
can I tell you
remind
guys
you.
something? I'm heading out. I appreciate this. Alex,
No worries. So
Monetive,
first thing,
Brandon.
right, before you head out, let me say
Listen,
something.
I just want to tell you guys.
No. Hold on. Before you
this is
go, I want to
precious
say
time.
something.
No,
Right?
I'm not leaving. I'm just want to tell you this is all good. Like I love this space, and it's just
No,
so
I didn't.
entertaining to a point I don't want to sleep. But
No. I was just going to say I talk too much first. Okay. So I apologize for that. I do talk too much. So irrespective of what people think, I do talk too
you talk
much.
with information, so it's like
Hold
I'm
on.
not trying to dismiss it. I love
Hold
it.
on. Normally I come prepared, so I don't talk too much and I add value. Okay. Today was very haphazard because I didn't think what we were going to do. But let's say if we are going to do a space, let's not do it this coming week. Let's do it a week later, right? Like next weekend. I'll prepare a little bit more. I'll talk to Brendan. I'll probably bring Archana to that. Maybe we can do it more organized so there is a proper flow to this, right? We jump back and forth a lot.
Yeah, and what
What
I've been doing, Monetive, is snapping screenshots, right? So I have a whole file of shots that if we, when the time comes, and we don't have to use these, but if you're gonna go over this, similar trades, we can set them up to where you can tweet them out, or somebody can tweet them out and then put them up in the nest, and have that organized to where people that are there in the space, where you don't have to worry about doing it like in the while you're speaking, you know what I mean? I think that's a lot of it too, like a lot of pausing, like setting the charts up, so I'll share this with you.
What I do, trader, I just look at the time. Like while I'm watching this video and listen to it, if he says something like 45 minutes, I'll go back to this video, and it's 45 minutes later, I'm at the time where I need to hear it. Like
no, for sure. I mean, I've been writing
it.
timestamps too, but I mean, just to share on spaces, because that was one of the things I think or you could do a thread even, Monetive, and post it.
Yeah, I might actually take something
like
this tomorrow, but this is a debit. I'll play with this, right? I might actually end up taking a butterfly tomorrow instead of I might wait on the put spread until it revisits the high, because we're 8-9% below, right? And this thing has, I don't know why, I don't know what people see in this to pay 80 times next year's earnings. It just makes no sense to me. But if it does revisit the highs, that might be a better time to do a put spread. Tomorrow morning, I will check with Archana, make sure that this is the right trade. I'll play with the trade. So maybe I'll take a butterfly trade on live with you guys.
Monetive.
Keep it posted on Discord. I would love to see it, brother.
Yeah,
we'll be live all day.
Yeah.
Monetive, I may not be able to take it along with you guys. I don't have the luxury. Can I take it later, based off of what you post?
This stock moves a lot. As long as the price is not moved, the trade might be the same, right? But you know what? Ping me. We will during a time when you're there. Just ping me. I'll leave the space. We'll find something. Then we can come back and take the trade together.
Okay.
All right, because I can quickly check with Archana. I don't want to. If you're serious enough to be taking the trade, I don't want to be the person verifying that. I'll ask Archana to verify.
Okay.
Again, I'm not the expert. Okay, I really am not. This is just for me. This is basically trial and error using a tool. For
Right.
Archana, she can zero in saying, yeah, the stock is this number, here is where I want to place the wings, here is where I want to place the body, right? She can visualize that. Brendan can visualize that in his head. I cannot. I'm
Right
not.
now, brother, that's what I said. I'm not
Yeah,
going to. I probably won't take the trade, but I would love to watch how it plays out and then learn off the mistakes
yeah.
and
Well, look,
everything that works.
once we find the trade, we'll save it. Then maybe, every few days we can come back and take a look at the performance, right? I didn't even know I could do that, right? But now that I know,
I was just gonna say, and that's what and Brendan, and so on next Tuesday, right? This coming Tuesday, we're gonna do a talk, the talk that we did with Brendan before a lot of you guys were even in here, I think. We tried recording it and it didn't, and the Zoom cut out a couple times. So anyways, we're just gonna redo that. But he went through some of this. And if you go into the Discord, right? You go into where it says Brendan options, he's actually posted some of the things that he's taken right from OptionStrat where they're saved, and you can go in and actually view, you can, follow the links and, go in and like, you can view some of those trades and see how they performed over time. So it's, but no, OptionStrat's awesome. I think just playing with it and moving the strikes around.
For most people, it's worth it. I'm just, I just wanted to show you something, Sigma. So, Alex, this is Ninja Trader, right? So I just wanted to show you what I use, right? So if you see, unfortunately it's small. I
I've
cannot.
heard a lot about Ninja.
Yeah.
But basically what this is, right? So this is my Nissan scanner. This is a 5-minute and this is daily. So it actually prints the pattern that it's forming right there, right? So I don't have to look for it, right? So I just put this window where I can see it. I go up, I don't even look at the chart. It'll tell me, hey, I can set an alert on it. It'll tell me, hey, Apple has a bullish engulfing pattern. Then I can go back to the chart. I don't even
on your scanner filter, do you ever scan for low float and short interest for the small cap stocks?
So I'm not fast enough to take advantage of those. So I'm really not a trader. You guys have to understand, when I said that, I'm not being cute about it. I'm just really a bad trader. I can do really good swing trades. I can do really good investments. I know how to hedge. I know how to do, all kinds of shit that's time based. But if you ask me to do something a week or less, I'm like a deer in headlights, man. I'm really not good.
You're learning, Monetive, you're learning, brother. We're learning,
Yeah,
brother.
yeah. So things that move fast, right? I freeze because I need to understand the data. And like I've even talked to, what's that guy's name? The biotech guy. What's his name?
In the chat.
Yeah, this guy has a Discord. He's a big deal, man. He pumps and dumps this stuff all the time. I've even talked to him. Atlas, right?
I know
you're talking Atlas?
I have no clue.
Yeah, I mean, I know. I think
this
I
guy.
know what you're talking about. Yeah.
Yeah. So this guy has a Discord room. I've even talked to him. Whether what he claims is true or not, I still don't know. But the point is, they get in and get out so fast with such volume that I can't even do one part of the trade by the time he's already out. So it's useless for me, right? I cannot do it that fast because my mind is.
Listen, with him, and I've been in a lot of his rooms. His money is not his money; it's his uncle's money, is what he said. Like your money is hard earned, so you're not willing to whisk it. Where his money is like given. So I heard him say this. I know what he's talking about.
Yeah, that is 90% of the answer. The other 10% is I need to first understand the trade, right? These guys have instinct that they know because they've done this 1,000 times. This works, so they'll just do it. For me, even if I've seen it before, I have to think through, why does this work? Why should this work? Why can't it go against me? By the time I'm thinking the second question, the trade is over.
But that's what That's what's going to make you a better trader. Excuse me, I had a couple drinks. That's what's going to make you a better trader. I feel like that guy.
It makes me
I feel like that guy
a better
reaches a lot.
investor.
Yeah, yes, exactly. That's why I'm in this space. That's why I don't. I hear him, and I just feel like he's a reacher. But if you deal with traders and Sigma, like there's zones, there's levels. So if you respect the levels, that's where it's patience too, it's discipline.
So, but
cool with
one thing I'll tell you guys, it's most important thing that I have learned over time is first find a way to do a scan of the market on a regular basis, right? Otherwise, what we do is, so not for your day-to-day, okay? Don't change anything you're doing for a week or 2 weeks or less. Whatever you do, you are in the right hands. Do not change anything. But when you talk about investing, what you need to start doing is scan all the time, right? Set aside a certain bit of time every month or every other week. Scan the market, find a criteria that makes sense to you, whether it's I want this P ratio or less, I want this growth, I want this dividend, I want this yield, I want this sector, whatever it is, right? You need to come up with a scan that works for you. And then every one of those stocks, go take a look, find out a little bit more. By the time you do that for a year, you will already know what to look for, your scans, right? Like today, right? Every week when I run through my, this one, I don't know, but like, for example, defense stocks, right? I spent a lot of time already. I know that I'm going to go long in a lot of them in the next quarter. So I've already spent a lot of time. Within 5 minutes, I can scan the 15 stocks that are in my watch list. All it needs is I can scan a chart, 3 charts in a minute, because I know what I'm looking for. I don't need to find the PE ratio. I've already narrowed all that down. I've already got a list. That's what will become second nature to all of you guys, right? Like Alex, you're saying that your portfolio is getting to a point where you need to put some of that away from day trading, right? You need to start putting that away to better, longer, safer but lower return places, right?
Absolutely.
So that's my thing, right? But that doesn't just happen, right? It's not like somebody says that on Twitter and you go buy, right? It has to be much more thought through, and that's where it starts with. Why do you want to buy a stock, right? It has to be fundamentally good. It has to have growth. It has to have technicals. So I buy it now. If it has everything but the technicals suck, you don't want to buy it now. You want to wait till the technicals get better, right? So all of those things have to line up, and all of what you learned will be useful in different parts, right? Technicals are still needed to get into the stock and get out of the stock. Your your stop losses, your levels, none of those change. They're all important. They're all valuable.
I gotta say, it's pushing 12:30 over here on the East Coast.
Yeah, I was actually going to show you guys something, but this stupid thing is not loading. I wanted to show you, how it shows up on the chart. Anyway, maybe I'll share it tomorrow when I'm.
I think tomorrow's good, brother. But I appreciate the information, so I don't want to lose it. But
yep.
Yeah, well, and listen, I want to talk more about the swings. Like, I mean, the options and the option strat is great. I'm glad we got a bunch of that, obviously, but I definitely we should do another call at some point. Maybe we do the space first, next weekend, not this weekend. That's fine.
Let me put some work into it in the meantime, right?
Yeah.
So for example, right, we talked about defense. So maybe we can take 2 or 3. I'll create a smaller list, and we can scan that list and see, maybe 10 stocks, let's say 3 from defense, 3 from tech, and 3 from something else. And let's find swing trades in those, right, as we come into earnings.
Yeah, absolutely, man. And I mean, there's I'll remind you tomorrow, but I do want to get a list of just the names from you that that you have an interest in, even in the defense stock, the defense sector. And we don't have to do it right now, but you can just message me, and because what I'll do is I'll run through and chart them, because that's some of the things. I mean, LMT, obviously I know a couple of them, but we'll talk about that. We can just continue this as we go on throughout the weeks.
It's a small list, so I will send that to you tomorrow.
Yeah, excellent. And I'll remind you to just throw up some of the stuff that we talked about tonight. We can, post it into the Discord. I forget exactly what y'all wanted posted, but we can address that tomorrow if we want. Yeah, this was great, man. And we can keep going.
Yeah, traders, I appreciate you.
We'll just keep continuing
appreciate
this, and as it becomes relevant, and as trades are taken, we can always revisit them on calls or whatever you guys want to do. So
yeah, and
Yes, sir. Thank
also,
you.
right, so was that Anu, right?
yep, yeah, she was
She was
talking
asking, can we do this, or maybe it was the other lady, she was asking, can we do it with the stocks we know, right? Of course, if let's say Apple comes down to whatever 125, I think Nargis has levels for it. That's a good place to start too. So she has these longer term levels, right? So let's say Apple comes down to that level, would we make a hell of a swing trade? Right? You don't need to find new stocks, right? Like tomorrow, AMD is going to take a beating, right? They pre-announced. You see that?
That's already coming in. Yeah, I thought about selling some puts on AMD, but I think I'm gonna wait and see where it goes, obviously.
So depending on where it where it pulls back to, it might be tradable from there, right? So I've made good money after sell-offs, right? Because it always gets oversold and then bounces back 5-6% from the bottom. That 5-6% on a swing trade can double your money.
Absolutely. Yeah, no, and I want to talk more sometime about the what you went into just briefly about how you set up your swing trades, right? About buying the commons like 30%, and then if it dips, waiting for it to find support, and then adding on to the leaps 10% on with leaps as it runs up. So we could even do just separate segments on that, keep it shorter if we wanted to, or not. I can break these up. See, that's the thing, I can break these videos up afterwards. It's not a big deal, to just chop them up if people, if we want different sections of stuff, and all that stays inside the
actually that leverage de-risk model, that's what I call it, right? So you're de-risking the cost invested by leveraging up, right? So your options are higher leverage, but your cost come down. So anyway, it's an interesting idea. I've been refining it. You have to trust me. I've lost a lot of money doing it over a decade and a half. Finally, I know how to do it well enough to make consistent profit.
Yeah, that's how it always works, man.
But nothing will work when we have these 1,000-point days, right? There's no chance.
Yeah. Right? And that's why I don't swing.
All my experience is worthless, right? It's just completely gone. So you have to, this might not be the best time, but as soon as Fed goes on the sideline, all of those will start working.
Well, and there's going to be, this is some opportunity times right here, that's yep. And once this balances out for whatever the reason is, things are going to start, things will turn around, and it's going to provide some real opportunities. We want to maximize that, while still managing risk. You don't want to just blindly go in and think everything's going to go up, because that's not the case. I don't think that'll be the case next time around, unless the Fed pivots and does some crazy shit. But anyways, we'll talk about it as it happens. All right, awesome. Well, thank you guys. Appreciate everything. Thank you, Monetive.
Next time I will be more organized, so I have to talk a lot less and make a lot more sense.
No, this is good. Listen, everything made sense. Honestly, this is it's complicated shit, right? So you gotta spend the time breaking it down. People ask questions, which is good. It leads off on side notes, but the thing is, like, you got to do that to get it helps people understand. So I think it was fine. I think it was great. So I think we'll do more of these, man. This will be great.
It was amazing. I do have 10 million other questions, but I wanted y'all to get all the information out. I hope we can have another class sometime soon. I'm going on vacation next week, so I would like to do some of these strategies when I come back.
Yeah,
So
well, that's the thing.
ideally,
That,
right?
yeah.
I am so when we have quiet periods, we can, we can do, we can have a Discord. What is that thing called? So trading pit, right? We can talk there too without disturbing the room.
Yeah, and that's 100%. I mean, the voice channel there. You guys can use that. You can
Yeah,
listen, if the market's not doing anything, right? I mean, if there's really no trades, we can always just hop off and do, do a 45-minute, call on Zoom too, if need be, Yeah, I mean, there's options here for sure. And actually what I'm looking to do is open up, or I got to talk to Zoom and figure out exactly what the right way to go about it is to make this, to where maybe we have multiple, we can have multiple rooms on Zoom. And, so, I mean, there's a lot of options that are coming in the future.
See, I came to your room because I didn't want the noise, right? And I can't be guilty of the one creating the noise. So I typically try not to, get in the way during the prime trading hours. So, because I'm looking at you guys and learning, right? I'm listening to everything that's said and I'm learning, right? So middle of the day, right, when there's no other activity, we can do other things, but not the first hour and a half or the last hour.
Yeah,
I'm
no,
fine
and
with
that's no, and we'll it's good. It's good. And that's what I want to hope. I'm you can get different rooms and whatnot, and that way it's like, hey, if we still, if people are still trading here, they just want to see the charts, right? You can still see the charts. Because I mean, look, there's gonna be times where I'm not around during the middle of the day. Shit comes up. I mean, right now things are quieter in my house, but I mean, eventually, like, we'll go on vacation for a week or two. I mean, things will come up. I'm sure Les will do it, and there's gonna be opportunities throughout time where it's not always gonna be exactly like it is, right? You know what I mean? So it's not a big deal to adjust things. So.
Yep.
But all right, everybody, have a great night. I'm gonna head to bed. I will this will process overnight on the cloud, and then tomorrow, I'll get it uploaded and whatnot. That all takes time, obviously, but definitely by midday tomorrow we should have this in a format that people can go back and rewatch it. So
Thank you all so much.
yep, thank you, Monetive. Appreciate it, man.
Thank you.
Really
Thank
do.
you.
And
I'm
Brendan
glad.
for stepping in.
Honestly, guys, I'm learning as much from you guys as I'm mouthing off. So, take it with a pinch of salt. I can do a better job than I did today. Seriously. Right? I just,
Well, it's a personal challenge. How about that? I know what
it's
you mean, man, because
it's an
we do the
uncoordinated
same.
mind, man. I've gotten to a point, right? I'm 54, so my mind doesn't keep up with the pace of my thinking, or the words come out faster than I can think.
I mean, I do that already anyways. I mean, we talk, I mean, Les and I joke. I mean, it's like, you think, I mean, people are like, oh, the spaces were great. And I sit there and I think of myself, I'm like, God, I feel like I repeated the fucking, 10 wrong things, 3 times, I mean, it's just the way it is, man.
That's why I love Brandon, man. I mean, the guy is so analytical and thoughtful. It's amazing guy.
Yeah,
And
it's gonna.
he is the person to learn from, right? I can provide a lot of information, but in another life, I'd have been a professor. I actually wanted to teach, but I tend to get off on random topics. So my kids will pass.
Listen, so do most professors. You just don't hear it because the classes are closed now. Well, Brendan is going to talk Tuesday. So Tuesday at 9 p.m. we're going to redo his the call with him. He can go through OptionStrat. I know we touched on a bunch of stuff today, but honestly, this was great because it'll be a bit of an intro to it. There's a lot of new people here as well. That'll be
the way to do it is I come up with the thesis and the trade, and he explains the trade and OptionStrat, because I think that part he's much better.
Yeah, well, and I'll tell you what, man. I mean, I've been looking at OptionStrat a little bit here and there, and I mean, I understand, the option. I understand, like, behind the concept behind like what the options do, right? But at the same time, the more we all learn this, the more we can all chat about it for sure. I mean, it's I'm waiting. I'm glad that we got this recorded. I'm looking forward to having Tuesday night's call recorded. because that, you know, it's just, there's so much information that if you're really interested in it, you're going to go back and rewatch it, you know, if it's something that, and look, for a lot of us that have these larger portfolios, this is a way to, I mean, this is a way to put some of that cash to work without the massive risk. I mean, that's just bottom line. I mean, it's
Exactly.
so.
Yeah, and remember, right? A lot of those can also be used to hedge your bigger positions too, right? So
Absolutely.
because a lot of the flow we see is hedge.
Yep. I mean, just the concept, I mean, even, you know, of just selling puts, right? Like selling the put, if you want to buy something, you know, don't just step in and just buy it. Like, you know, it gets rid of that whole FOMO factor, right? It's like, hey, I'm collecting premium, and you know, if it dips down and I, you know, and I get you know, it gets exercised, then I own the stock, you know, and it really changes your perspective, but it also makes you learn what options really do and what they are, right? And then you can come up with, you know, better strategies and more effective strategies. So really cool stuff, man. But all right, let's cut it here, and we'll all chat tomorrow for sure. I'll remind you in the morning about the stuff to post Monetive if you need a reminder, and we will we'll continue this on. So have a great night. Thanks everybody.
Good night, guys.
Good night.
Take care.